When I look at inflation in Nigeria, right, there are predominantly largely two drivers of inflation, money supply growth and the exchange rate. The way we see inflation internally, it's not just a rise of goods and prices of goods and services. It's a manifestation of imbalances elsewhere in the economy.
Doesn't this just create an entire shift, a behavioral change that we all underestimate?
Yeah, it does. I mean, but
because wage growth is not going up, is it?
Yeah, we spoke about import substitution, but we spoke about everybody now buying locally.
There's a reason why Nigeria is the poverty capital of the world.
Yeah.
Incomes have been bastardized.
Yeah.
More than half of our population are in multi-dimensional poverty.
In some offices, when people see their salary, this is not a joke. You would see that they take it on the salary and they go and bet with that money. Then they win, then they start spending. But that's
for real?
Yeah.
If for some reason you have a very rogue asset manager and maybe investors lose their funds, who do they go to?
They go to SEC.
So the question is, does
but
SEC...
let's dial back. We need to have a regulator who has a core interest in ensuring that the industry they are regulating is growing and that the industry is profitable.
Hey, let me ask my question. I'm a PFA. I earn my fees.
Yeah.
I'm a pension contributor. And over the last 10 years, I have not seen a return that is above 10%, despite inflation and co.
Okay.
And you're sitting here worried about the return that is going to a PFA. And you're not worried about the return that is going to the RSA. Which one is more important to you?
Those are two different conversations.
They are connected. So they are connected. How? So what incentive do I need to give a PFA to give an RSA a better return?
How does capital solve that return problem for you?
Return. Bamboo and Trove were able to disrupt the retail market, retail stockbroker market, because they had funding.
Low capital adequacy has not prevented the origination of a Bamboo or a Trove. It is not because capital adequacy is low, is why Bamboo or Trove came alive. They saw a market opportunity. They convinced private market participants that they need to raise capital to go after that opportunity, and they did.
The reason why stocks, solid businesses like GT Bank have valuation multiples or earnings multiples of max 4x, 5x in this market is because all of you here, you issuing houses, don't have the liquidity to drive the market.
No, cool down. It's a valuation problem. Issuing house don't buy stocks.
Don't buy stocks. Why don't buy stocks?
Who is meant to buy the stocks?
Asset managers.
So that's why I asked you. So what are the issuing houses doing then?
Their job is just to bring the deal to the market.
Why are they not bringing deals to the market? Hello everyone, welcome to Drinks and Mine, brought to you by Biometrics. As you can see, there was a lot of discussion going on before we went live. So of course, you want to catch what we're talking about, just go to the... You have to be a member.
Oh, was it recorded?
We can do a session after the session.
You see, so I mean, all you need to do is just be a member of the Drinks and Bikes member club exclusive. By the way, as you can see, it's it's a full house already. The full gang is here. I mean, every first Friday of the month, you have the full gang in the house. There's no full gang without the man. Sam, welcome back, bro. Sam has been on some very, very good weight loss stuff. He's on some health moves. And stuff, I thought he was going to come back, looking chubbier, but I can see that he's kept it really good.
Yeah,
nice
no carbs, no rice, no pasta, no bread.
Wow.
Yeah,
looking good.
Just eggs, fish, and vegetables.
Hey.
Well, the guy on my right and on my left, these are simply like pushing metals and stuff. I don't know where they're going to with it, but
I think I've only been to the gym once this week because
and then we have
you carry a lot of weight. I see.
Yeah, he does. I trained with him about 2 months ago. I didn't show up again.
Instagram account. You bench proper weight.
He's never come back. Yeah, I've been working out since uni. I stopped sometime, but I came back again like 2014 and
yeah, because I need to do a lot of resistance training.
It's really it's a pain. Build muscle.
It's a pain.
All right, talking about muscle, there's a lot of muscle today because the discussion today is likely going to be, steamy. There's a lot to talk about. As the new theme for whenever Sam is here, we're going to do like a recap. Let's look at everything that happened in January, review it, and then we'll look, into February, to our crystal balls, and figure out what to expect. There's a whole lot happening in February, of course. We expect the CBN MPC to meet in February. Inflation numbers are going to be out. We think GDP numbers are likely going to be out in February as well. There's a whole lot of data to chew on. And then more bank results, more company results are going to be out in February into March. So we're going to be looking at all that outlook. But we want to start first with January. A lot of stuff happened last month after we had the first session, Sam. I don't think Otumba was there as well. So I just want us to sort of go through some of the things that has happened. Let's first of all start with the macro. And we saw inflation numbers come out, and there were a lot of, I don't know, some people were like, okay, well, looks good. Some people doubted it. IMF actually came out and said, it was good. But beyond how the numbers were generated, what do you guys think overall of inflation so far? Do we really think that it's going down, like personally?
First of all, what was the headline number?
I think it's 14.29 or so. What did they close at?
I think it was 15.1.
Okay.
Yeah, so we need to start from the fact that we
expected it to really spike. You think we expected it to really spike, right?
No. For base effect. Right?
For the base, for base effect. So
on that show, the last show, I said I have a sneaky feeling that they will surprise us and keep it low.
Tunji, I don't remember.
We eventually hit that 50.
Play the tape.
The challenge is when you say that, it kind of gives credence to the idea that this thing is being doctored.
No. Right? So here's the thing. I've always said this about statistics. Statistics is about methodology.
It's about what you put in.
It's really about methodology. If the methodology says we're going in this direction, we're going to go in that direction, irrespective of whatever you feel about the numbers. So that's why methodology and the arrangement is important from day one, because if you have a faulty foundation, you will always get faulty outcomes. Right. Yeah. So when the methodology was changed, the base year was changed, I knew that we're going to get here. All those rigmarole in December around we trying to explain the numbers, I kind of just felt
no, but these are statistical. This was just these are statistical realities,
right?
The
reality of what it is now.
But
so what are we seeing? Because regardless of what the MBS does or what anybody else does, we still need to run our own numbers and then extrapolate and figure out, okay, our price is going up or not. So what are we seeing now from,
So the way I look at it, I mean, these inflation numbers were always going to be noisy. And I think from February, we'll clear out the base from the old and new methodology, and then we can start to look at on a comparable basis. So it will be a bit cleaner.
Yeah.
But we, in the absence of being able to validate, right, you need to look at anecdotes, right, to kind of give you a sense of what your inflationary pulse is. And when I look at inflation in Nigeria, right, there are predominantly largely two drivers of inflation: money supply growth and the exchange rate, right? So money supply growth, I think we probably exited December at 10% year on year. That is probably the lowest it's been in probably 6-7 years. Remember, we're also coming from a high of 80 to 90% growth in money supply. And I think there are a lot of studies, and I think IMF had a study that if you look at Nigeria inflation over a 50-year period, the money supply explains around 50% of inflationary variables, inflationary trend. The other 25% is measured by the FX rate, right? And the FX obviously on a year-on-year basis was strengthened for the first time in 13 years, right? So those are big drivers to inflationary direction. So I do think that we are seeing a deceleration in inflation. But I would also like to caution that a deceleration in inflation is not declining prices.
Yes.
Right?
Yeah.
So the consumer have seen a permanent damage to their balance sheet
yes.
as a consequence of higher inflationary pressure. Yes, it is true that the pace of growth
has reduced.
Right? So if price of goods goes from 100 to 200, right, that's 100% inflation. If it goes from 200 to 300, that's a 50% inflation. Inflation have decelerated,
but the
price is still at 300.
Still up,
Right. So we are in a decelerating inflationary environment. There are pockets of the inflation basket that are in disinflation. For example, I think certain categories of food are in disinflation.
The grains.
Yam is in disinflation.
Exactly. Beef was also quite stable.
Yeah. So we had a good harvest season.
Yeah.
So it will be quite good to see what the data prints on the food side in February and so to summarize, Ugodre, is I do think that we are in a disinflationary part. The data might be a bit mixed, but I think the lived experience of Nigeria would suggest that although prices are rising, they're clearly rising at a much slower pace than they have in the last 3 years.
I dare say that if we had not used the base year we used, we would have inflation have reduced to close to the lower 21s, maybe even the high 20s as of now.
I think lower.
Even so, I to me, I just never saw why we did that.
But
the methodology
compared to 20-something% is
again that's the
right?
optics of it, right? But I'm saying if you had given it a year that was respectable by statistics basis, you would
a better year. So like better year.
You would still be around 20 point something, which is not bad coming from the highs that we had, the other time. So 15, 14, we expected this, but I just saw the trajectory, the messaging kind of felt, we've written the answer.
No, but the input variables, I don't want us to, because obviously we are kind of dealing in a society that has very low trust, and there are always question marks around the integrity of MBS on the back of unemployment data that came out at 4%, and people had question marks. And then when the rebasing happened, people just think that people are trying to solve to give Baba his 1 trillion economy, right? So I don't want us, there are question marks around the credibility, and we can't debate that. But like the reality and the lived reality is that where it is the direction of prices, it is quite clear. And also another huge input variable for inflationary data as well is PMS prices.
Yes.
And if you look at PMS prices as at when we deregulated to where we ended the pricing for the end of the year, even with the war that is going on in the downstream sector. We're buying petrol at sub 700 naira, even when landing cost was around 900. So there's also somebody's taking that subsidy for the consumer. So that's also positive. And then I want to end on a final note, because the way we see inflation internally, it's not just a rise of goods and prices of goods and services. It's a manifestation of imbalances elsewhere in the economy, right? So when you think about the identity equation in economics, right, basically your private sector balance, your public sector balance, your external balance, if you add all of those balances together, it needs to sum to zero. It's an accounting identity. So oftentimes when those are out of whack, prices will need to adjust to take the shock. So what we've had leading up to this adjustment is that your public sector balance was whack. Your external balance was screwed because you had persistent current account deficits. Your private sector didn't have the savings.
So current account deficit or fiscal deficit? Which one?
So fiscal deficit is your public sector balance. Your current account, your balance of payment, the entirety of your balance of payment is your external balance. And then your private sector is the difference between your savings and your investment. That's your balance, right? From an economic perspective, you add those three together, it needs to sum to zero. Right? If that doesn't happen, you take a shock.
Yeah.
So what we have experienced in terms of the manifestation of that imbalance is what has come through as adjustment in exchange rate and inflation. Right?
So is that how you calculate your FX, the value of FX in
differentials?
So what it does is it's a fundamental signaling tool, but it doesn't give me any timing signal.
It's almost like a rear, right? Isn't it?
So I'm trying to
like a real exchange.
So I'm trying to bring this to reality now, right? So I remember there was a post I saw on Twitter. I just dug it up now a few weeks ago, where some guy showed receipts of the same item that he bought. You know, in 2020,
I saw that. Yeah,
and now I think everything he bought, his entire grocery shopping was like 22,000.
Yeah, I remember those days.
And then the same items, I believe, because I can see now. I'm seeing it here.
So what year?
What
was the base?
2020 was his base.
So 5 years.
Yeah.
5 years.
Was it 5 years ago?
Yeah, 5 years ago. Yeah.
I'm trying to
So
remember.
the same item he bought in 2020, he bought it in 2026. The same item he bought at 25,000. I beg your pardon, 25,000.
Yeah.
Cost him 147,000.
Yeah, but that's a huge
but also
effects for me.
It's also a function of what his consumption basket
but-
looks like, because his basket might not be
It's
represented.
the
But it's the same thing.
No,
It's the
I'm
same
saying
thing.
so in the
He bought the same thing he bought in 2020.
I get that.
Yeah.
But the inflation basket, right? So when the inflation basket gets decided, what the statisticians try to do is that they try to approximate the consumption basket of the average Nigerian person.
Exactly. So what I'm doing
So this
here,
guy is clearly not average.
No,
because
no,
my
no,
inflation
no,
is
no.
clearly higher.
Exactly. So what I'm trying to do here, I'm trying to disconnect
The
these
numbers from
the
actual
statistical
reality.
numbers that is out there,
Yeah.
which is fine. And I'm trying to talk reality now. And if there is any proxy that you can come up with, this is a very good proxy, because it's the same items you used to buy.
Yeah.
And that's how the average Nigerian thinks.
So
Same thing I used to buy 5 years ago, I'm buying it now. Yeah, this is a 25,255 versus 147,000.
Okay.
So
That is like
So that means
6x,
prices
isn't it?
have gone up
Yeah, yeah.
6x. So
Six,
it means that
7x.
over 5 years, because what I think
So
about
what
it,
level, like, because sometimes we see this thing, right? We all analysts here, we see these numbers, we see these things. When you see this sort of reality, Otumba, what does it mean? Like, is this like a destroyed economy? Like, have we seen lives virtually destroyed here?
Because you know that wage growth hasn't gone up 6x.
Yeah, because I'm just. So are we dealing with something that we probably don't know that is a larger problem that we have? We're just
It's a larger
basically
problem,
just suppressing.
But I also feel that's why, in certain offices you realize that, well, it's in some other offices, when people see their salary, the first thing they do is they put it in betting apps. I'm serious. This is not a joke. You would see that they take 50% of the salary and they go and bet with that money. Then they win, right? Then they start spending. But that's
For real?
Yeah. I've seen situations where someone took 50% of the salary and just went to go and bet straight.
They bet everything. All
Maybe 50%. You bet.
Because my problem is that Sam and Tunji, even Arnold, doesn't this just create an entire shift, a behavioral change that we all underestimate?
Yeah, it does. I mean, but
because
we
wage
spoke
growth is
about,
not going up, is it?
Yeah, we spoke about import substitution, but we spoke about everybody now buying locally. The receipt is Rennie's, if I can
let me
mention,
see.
right. So
Yeah.
it's a store
So
that
the two
and this
things-
is why I talked about FX.
Yeah.
Because it's a store that I'm assuming
So I was going
imports
to
goods.
say something about that, because the larger part of Nigeria that took the biggest price hits are imported goods. So they got a massive hit. So they went up maybe 10x possibly. A lot of the cereals, the foreign sausages, all those kind of things, custard and all those things went up. The average Nigerian that we're actually talking about is the people who actually buy, rice in, cups and modus or buckets and Gary in buckets and things like that. Now, I don't know the prices of a bucket of Gary in 2020 as compared to now. That would be, for me, a better reflection of the actual representation of
Why
how
isn't
it's
this a
hitting.
better?
Can we check?
The reason why this is
Let me call some of the
four
items, here. There's
yeah.
Indomie, there's Golden Moon, there's Quaker Oats, there's Cousins Baby, there's Lipton, there's Pringles, there's Blue Band. Hold on, there's Titus Fish, there's Chivita, there's Farm Free Juice, there's yogurt, there's Garden Fruit, there's Cabin Biscuit, there's Semovita, there is Cerelac, there is spaghetti, There is
I have a question.
like
That basket,
doesn't this
that basket,
and replicated,
that's
same
an
thing.
elitist basket, right? Let's be
see what I'm
let's be-
saying? You
And,
see what I'm
and,
saying?
and also,
Okay, so-
and also,
so is it an elitist? Are we
back
calling
to
this
his
an
point,
elitist
it is an
basket?
elitist basket relative to the average.
Relative
I
to
think,
the
I think,
average
I think, I think
Nigerian.
we shouldn't.
Because
we
So
shouldn't-
wait, look, because when you say elitist, if we look at strata, so you have
Okay.
you have
maybe elitist is a
HNI,
stretch.
upper middle class, lower middle class,
Okay.
poor. So are you saying this is
No,
like
guys, even middle class
HNI?
people are not shopping that basket.
No,
I think let's not.
I don't agree.
I don't agree, man.
Let's sugarcoat.
3 crowns?
Let's not
Indomie.
sugarcoat.
What are we saying here?
Obviously,
Let's not sugarcoat the
What is
level
in
of
here?
income depravity that we currently have in Nigeria.
I mean that e-commerce space, right?
Yeah.
I look at what we sell, right? The truth is, and our focus is the retailer, right? The fastest moving thing in this country, right, is dry goods, and that is noodles, pasta, semo. Those are things that constantly are on the top 5 things that we're buying into the warehouse to sell to the retailer. So, I mean, so what I'm saying is that list, to some extent, is representative, right? The items that he has there. But noodles, past those dry goods, if you look at the 5 years where we've had also bad harvests, right? Because there hasn't been good yam, whatever.
What is the proportion of Nigerians that drink Golden Moon?
No. I don't even think that's.
No, you'd be very surprised. So I just said, forgetting Golden Moon. I didn't say Golden Moon, but I said to you,
I think he thought about it.
noodles. I said to you, noodles, pasta. Now, you can argue that maybe the kind of pasta he bought is.
I mean, you can even argue that he
But-
went to an elitist supermarket. That's fine. But my
But-
point is that everything here.
Let's say something. Nigeria there's a reason why Nigeria is the poverty capital of the world.
Yeah.
Incomes have been bastardized.
Yeah.
More than half of our population are in multi-dimensional poverty, right? We shouldn't sugarcoat it.
Exactly. That's
Right.
what I'm saying.
Yeah, we shouldn't.
That's what I'm saying. That
Yeah.
the fact that even if this is, let's even call it middle class.
Okay.
Middle class grocery shopping
upper
is
middle
up
class.
No.
6-7 times, 6x, 7x.
Nobody's disagreeing with
Yeah.
that.
What kind of destruction are we facing
nobody's
here? That's my
disagreeing
point.
with
So
that.
imagine what's happening at the lower end.
No, what I'm saying is this. What I'm
Well,
saying
do you
is
think?
this.
Do you think?
I actually
Do you
think
think
lower
goods are
end,
6x?
paradoxically, I think lower end
is
may be a
better
bit
than
more
that.
sheltered.
Yeah, because
the lower end guy,
that's
what
about
I'm pointing
$100 5 years ago. It's about $100 now.
No,
And that's why I'm saying it's an effects
That's
issue.
what I'm
And that's what I'm
saying.
saying. You have to mention the
What's
supermarket.
$100?
Yeah, 25K
Okay,
5 years ago was
let-
roughly
let-
about
let me explain.
$100.
So
about 250,
this,
300. And then 1.5
this particular
now.
shopping cart, right? What happened between 2019 and say 2024?
It's a straight line effects. If you look at the effects
what
rate
happened-
of 5 years
what
ago, it's a
happened is
straight
that
line. It's
the,
literally a
the,
straight.
the effects of some
So
bad mismanagement.
dollar-wise, it still remained the same.
The effects of some bad mismanagement meant that we had to take a lot of hits dollar-wise. Those dollar hits fed directly into this list, right? Now, every other Nigerian that is not using that dollar list, whether on a normal day or on a good day, are the average Nigerians that we really should be talking about, because most of the people that, okay, so for instance, this guy, right? He probably or she probably bought this basket to prove a point. Someone like me had to have import substitution. So whether I was buying a certain kind of, so my son, right, when he was born, he was taking this funny kind of puree like that. At some point, boy started eating amala. We started substituting quickly because we understood that thing was expensive. I liked it. It made me feel like a very good dad, but it was hurting my pocket, right? So I had to substitute to, start making him eat amala and lafo and all those kind of things. But the thing is that the people that eat those dry goods, okay, rice may be a bit expensive, but gari, amala, lafo, all those kind of local foods, they are the people I would rather see this guy, because that was why I asked the other time, a bucket of gari in 2020, what's the price of a bucket of gari today?
It's not 10x.
Guys,
That's my point. It's not 10x.
That's what I'm saying. This is a straight line effect.
Guys,
And also, we
This is
also
literally straight line
underestimate,
effects. So the
like,
dollar
there are a lot
price
of people in
stayed the same.
Nigeria that also
Anyway, let's move on.
grow the food they consume.
There are other things to discuss, but we're going to talk about this at some point because
Power to the people.
I don't agree with your point. I think I really believe people at the lower end actually got it worse off. That's what
So
I
you
think.
think?
Yeah, because their base is
I
lower.
think it's
But if you
more-
look
I
at
think
it on a
they're-
ratio
I think they're
basis,
worse off.
our middle class
I
are
think the
in
place you can
LP
point
are
to.
worse
I think
off.
the place you can point to.
And there are several
the two
examples
places
out
you
there.
can point to that would have hit them hardest, especially if they live in a place like Lagos, is housing and transportation. But when it comes to food, their food has increased, but not at the rate of this guy.
Yeah,
Over 5 years, over the
All right,
same
let's move on.
I agree.
IMF recently revised our growth projection to I think 4.2% or so.
Up or down?
Up. Was it IMF or the World Bank? It was the World Bank.
I think.
Yeah. So and then I saw this report again suggesting Nigeria was contributing 1.2%.
Nigeria was also
contributing 1.2% or
to
so
world
to global
GDP growth.
GDP
I
growth
did
rate.
that math. It didn't make
Did that
sense.
thing? Yeah, I was wondering how they arrived at that
Please.
because
I didn't do
We're not even
that.
at
I
the
saw the
top three
number
in
and I just
Africa,
walked
so
away. Yeah.
what is
Have
going
you
on?
also seen news that?
But it's growth though. Sorry, because it's GDP.
We're just doing 4%.
No, but it's GDP. Yeah, but world GDP growth is what 0.7.
So that means more than 80%
No,
of
no,
the
so
world.
I
is
didn't-
more
I
than
didn't-
growth.
I saw
So it's the growth. It's not the
nominal
value.
global GDP is about $100 trillion, right? And then global GDP last year was about, I think 2024 was about 100 trillion, and then 2025 was about 117 trillion estimated, right? So basically, there was $17 trillion worth of growth that was added. And then Nigeria is expected to be 1.2% of that, which is about 90 or so billion when I did the math back of the envelope. The total size of the economy in dollar basis, on a nominal dollar basis, is probably less than 400 billion, right? So where did we get 25% growth from, right?
Yeah.
So I think there's a computation there that unless I was
going to point
it's good
out,
for the headlines, but
exactly.
I
was going to point
true.
out that we've just hired some lobbyists and PR
What is the $9 million that we paid?
But they cited the IMF, so I didn't see the actual IMF report.
IMF never. I don't know whether
I didn't see the actual IMF report, but I looked at that.
It was just a screenshot.
It was a
picture.
screenshot, and then they cited
some
IMF,
website.
but I didn't see the actual report.
To be honest with you, I didn't do the numbers. I saw growth and I assumed.
I did a quick back of
I-
the envelope. I'm like, this cannot be possible.
Yeah, because I know world
let's
growth
leave
is
it.
like
So you guys don't believe that?
Narratives are good.
NESG saying
So
we'll
think
do
about it
5.5%
now.
this
If
year.
you're starting from, let's assume you're starting from a real GDP growth base of like 300 billion, to be generous, and you grow by what we're probably end of the year at like 4%, right? So 4% on 300 billion is what? So that's basically $12 billion. $12 billion within the context of the global economy is pittance.
Exactly, that's what I thought.
Yeah.
Yes,
Anyway.
please. You don't understand how they did it.
So let's leave it.
Methodology.
That's guys, so you know.
Leave it like that.
By the way, NESG is saying we'll grow by 5.5% this year. I don't know where they got that number from.
Not going to happen. I don't think that structurally the economy is structured to go beyond 5%.
Was it a?
If you don't fix agriculture,
yeah.
I mean, we've had that discussion here before, and they said there's a pathway. There's a pathway to deliver it, to get us to 5.5%.
What's the pathway?
I think oil can surprise on the upside. Services can surprise on the upside.
Oil can surprise definitely. Services,
trade is coming through a difficult period, right? Transportation costs have stabilized. Margins because of FX stability should also improve. So trade can surprise you on the upside. There is also loan growth from the banking system that can surprise you on the upside. Remember, we are coming from a low base, right? Yeah. So, like, do we have a situation whereby we've done this and then we go through a period of high growth before we stabilize back to structural growth? I think even just looking at the output gap that exists in this market, we should be able to, at least in the short run, hit those kind of numbers temporarily.
And
then,
not even stay.
And stay then requires.
Should I give you the assumption?
Yeah.
The assumption is that the optimal consolidation pathway assumes, when people want to speak big grammar, the optional consolidation pathway assumes rigorous implementation of reforms across 4 pillars: macroeconomic anchoring, structural transformation,
they don't say
institutional strengthening.
Now. They said
That's
it doesn't make any sense. That's what we said.
And the pathway will deliver 5.5% growth in 2026, rising to 8.5% by 2029.
Okay.
Wow.
Okay, that was.
So let me say this. Let's stop. Let's stop.
Yeah, I mean,
this kind of thing. So
the words don't make any sense.
Let's not be doing this kind of thing.
Are we doubting?
Let's not. No, I'm not saying I'm not doubting them, but first of all, GDP growth, right? Especially whether we are coming from a low or a high base, right? What we're experiencing right now we're seeing resulting as GDP growth is really a stabilizing of the economy. It's just a economy that was in chaos has now stabilized, and then the parts that were producing but leaking through are now beginning to feed into the center. That's what we are seeing as GDP growth now. For us to see a growth that will take us to 5.5, first of all, before 8, there has to be significant spikes in what we are doing.
Catalyst, a stimulus.
There needs to be something really radical.
I know exactly what you mean.
It's not
this is just a recovery. Where we are right now, just a recovery.
Which is why I'm wondering.
Which is what we're talking about, the valuation, reflexivity.
This is not, it can't be a business as usual. They will just coast into 5.5 and 8. I don't like when we just do this English thing, because the thing is that a lot of people realize that by the time it is December, we would have forgotten this report.
You know, there was a conversation that Godre had this weekend where we said the government has used 2 levers to drive sort of change, right? Okay, subsidy removal, we've borrowed aggressively, and we're pushing through a tax reform. One thing that has been missing in all of this is the government has not used the capital markets to drive the economy. One thing that you saw a lot.
Capital markets in terms of fixed income or in terms of
they borrowed, right?
Because they borrowed like
So I'm saying capital markets, like the equity markets, right?
Equity market.
Investment cycle is happening right now in EM, right? So if you look at what happened during Obasanjo's government, there was that correction and sharp. And what happened when I was in England, 06, 07, the reason why I wanted to come home was when I would have friends come to London for the weekend and they are spending £20,000. They come on a Friday, leave on a Monday. And I was wondering, what exactly is going on? What am I doing in my life in London?
But for that reason, that's why we are all poor today.
I know. I understand what the implication of what happened then. What I'm saying is that what happened within that 06 to 08 was a strengthening of the middle class, right? Now, the truth is, no matter what the government does, the trickle down to the micro level is going to be an extremely difficult thing to do. So what you need to focus on is how do we empower and expand our middle class? Because what will happen is that the day everyone in this room here is expanding, right? What you want to give your gate man in terms of salary will go from 50 to 100 or 100 to 150, or your driver will go from 150 to 200. That is the only way that trickle down economics can happen, right? That we sit here and say that we want to start looking at how the federal government will intervene directly at that micro level. It's not going to happen. So we need to focus on how
the capital market.
And the capital market is the way to do that.
There was something you shared on the group.
One way to do that.
I really don't know much about what they were doing, but there's this index that launched on the AT50.
Yeah, Africa Tech 50.
I think what they are trying to do is to try and channel some capital back into the country, at least for tech companies in the country.
Yeah.
I don't know how it's going to work, but we need more initiatives like that will, channel.
I always have a problem with this idea of attracting capital. They say charity begins at home.
Yes.
Right? So it's when the foreigners see that the
People
locals
are
doing it, that they're like, okay, what am I missing? And they come in.
Yeah.
I think there's a misallocation of capital at a grand scale in Nigeria.
True.
You look at the pension assets, right? You look at the banking sector, and then you look at the asset management industry. We've basically existed to hoover surplus from the rest of the country into the state.
Yes.
Yeah.
That's been our job.
But you can't help yourself when the government is borrowing at such a
high rate.
That's fiscal dominance.
Why would I lend to you or buy your stock when I know that I can lend to the government? I'm not going to lose my job if you default, but I'll lose my job if you default or your stock goes to zero.
No, right. but this is why this macroeconomic reform is very, very pertinent. And I think it was Mayo that said it in the meeting where we have, like, we need to slay this monster called inflation at any cost.
Yeah. So which is where I want to get to now, because if we've all seen another thing that happened in January. So this is just a segue now. Another thing that happened in January was the 2026 budget that they're talking about now. And you've seen those numbers.
Yeah.
We were all here when they came up with the 2025 budget. And I think we sort of agreed here that budget didn't make a lot of sense. Now, 2026 budget is out. The assumptions are probably better. But is there the capital or the money to execute that budget to help achieve this macroeconomic stability that we're talking about? Is that budget going to engineer the growth we're looking for? Is it going to sustain inflation? Is it going to give us the capital that you want?
So we go
17 trillion
like I said, there's no fiscal space in Abuja. If we are waiting for Abuja to drive our growth strategy, we've lost the plot.
Yes. So where is it going to come from?
I think there's fiscal space in the subnationals, right? The state governments and the local government. I think there's fiscal space there.
Year?
I'm hoping that they use that fiscal space to basically catalyze some level of investment. Obviously, there's a lot of question marks around the efficiency of the spend in the money there. But expecting fiscal space in Abuja, like even if Tinubu wants to spend 100 trillion, he can't get it. The only reason why we had this nonsense growth in money supply that we had under Buhari was because there was a willing central bank governor that was willing to create unfunded liabilities to create.
But it's doubled over the last 2 years.
Yeah, but the pace of growth of that, I mean, there's no more ways and means. In order for you to fund your deficits, right, you need to come to the market. There are constraints to the ability to fund in the market. There's a level of growth that the pension industry is having that they can use that you cannot exceed. There's a level of growth that the banking sector is dealing with tight liquidity conditions that you cannot exceed. There's a constraint. So, for example, I don't think it is actually feasible for this government in 2023 to raise 23 trillion. The only way they can mechanically do that, right, is obviously we know we have a huge almost stock that is currently sitting in the central bank's balance sheet. And one of the things the central bank has been talking about is the concept of convergence between OMO and NTB. And one way you can possibly converge is that as your OMO, because there's a massive rollover burden, there's about 5 trillion a month over the next 6 months of OMO that needs to roll, right? The CBN can decide to roll less than that number, but still want to keep the foreign investors in, right? So as a result, the fiscal side will need to
exactly.
They will need to raise their own
those guys
parts.
can roll into that.
So they can do that for 2020.
At what cost though? At least 20%, 20 something percent.
Yeah, it has to be at that. It has to be at that cost. So the point is, so there are two options. So you either raise at very expensive cost, and that is what it should be. If you want to come and do fiscal dominance, the cost should go up.
Yes.
Right. So that pricing mechanism that exists to discipline the fiscals is actually working if the cost goes up. So that's one. The second part is if in the event that you are unsuccessful in raising the liabilities, we know what gives. CapEx.
Yeah.
Right? So when I look at the budget, I look at...
That part will never happen.
No, 13% implementation as at half. No,
we don't know how to. We don't.
So we have consistently under-delivered on CapEx implementation.
If you under-deliver on CapEx, how the hell did they come up with these growth numbers?
Which growth numbers?
This 5.5%, that like where's the growth?
We just said that was ChatGPT.
Exactly. So that's what I'm saying. And all the other projections that we have.
I think we missed the plot completely on Nigeria.
Yeah.
Nigerian growth direction is not going to be driven by the government. It is driven by the inefficiencies in the private sector that has now been taken out. Think about
like
it.
What?
For example, does Aliko need to go to Abuja to go and ask Godwin for FX? Like, if you're planning your business today and you need to raise money and you need to buy dollars to fund your imports, or you need to buy dollars to fund your machinery,
just come to capital markets.
You go to your bank and you go to the official FX market, you buy whatever dollars you need.
But Arnold, right? They are telling you that it's getting difficult for them to access credit to expand.
Who?
Their business in manufacturing companies. Right?
Yeah.
They're finding it difficult to get credit. Banks are not lending.
Credit growth.
So where does that expansion come from?
I don't agree with that notion.
No, but that's what it is. That's the reality.
I hear banks are aggressive now.
I went to visit one of our...
Even GT is trying to...
I went to visit one of GT Bank this week. And, I mean, they've guided this already. They're telling you that they are growing loans by 30% in constant currency terms.
As of when?
GT Bank
this is new.
GT Bank has one of the least loan books in the
No, I know. But have you seen GT Bank in the last 10 years on a constant currency basis grown loan book by 30%?
So this is something new. This is
no, but he said it in the last earnings call.
Yeah, but has that happened?
It will happen.
It will happen.
It will happen.
And I'm saying,
so it hasn't happened yet. That's my point. So before you go from 0 to 30% in a year,
the reality on the ground is
the reality
on the ground is when you go
another
to
analysis that my guys have done, right? They've looked at the last recapitalization since 1990. There's been 5 recapitalization exercises, and they've looked at the growth in loan book over the preceding 2 years, right? The lowest growth was about 33%. In the 1992 recapitalization, average loan growth was about 94% over a 2-year period. And in the 2000 recapitalization, it was close to the 90s. What we have had is, when we look at the loan books of these banks, we need to look at it in real terms, because the nominal terms are very deceptive. Our base for loan growth, right, is being decimated. Just think about a normal FMCG company that needs to import flour to make golden morn. Just for the sake of argument, the working capital needs of that FMCG over the last 2 years have ballooned. Right? So even just renewing your working capital financing to your existing customer base is going to naturally grow your loan book by definition, mathematically. Before you then add new risk and you then add growth to that stuff. So just a process of resetting of macro realities will create organic loan creation in the system by definition.
So say that again, because I don't know.
I understand what you're saying, but to what extent is my point?
Let me give an example.
To what extent? Like,
if Flour Miller is importing 90% wheat, right? That wheat was, let's say, $100. It was $1,000, right? Yeah. That is,
which was like 450K.
40K. In today, that is 1,500.
Yeah.
So what else?
So automatically loan big. So yeah, but that has been pricing already though for most of them.
That's what I'm saying.
Not really. We haven't seen the growth in loans. What we have actually seen, maybe at the top end, but what we have seen is capacity that have been taken out of the system. So there are a lot of people that, as those working capital needs expanded, they just short.
What we haven't seen though,
that was, and it did surprise me a bit though. There was a lot of it was almost an eagerness to. I'm not saying that
it's not eagerness. So if you're at FMCG, working capital is like your blood.
Let me rephrase that, because I just realized the reality of what I was just saying. I felt we would be more resilient to that phase, because we knew it was. Well, in the middle of it, you can never tell how
you can't fund your working capital. What do you do? You can't fund it.
Yeah, absolutely.
So now macro is now stable. That guy that had one line of biscuits, right? Can now come back. And obviously, there's a lot of repricing that have gone on in the economy. True. So you knew that obviously you were selling that biscuit at 100 naira, and your working capital needs have gone up. You need to reprice to the new, but you didn't want to be the one that took those pain. So you shut down your plants. Now you are stable. Biscuit price have doubled or tripled. You look at your numbers again. You call your banking guy, say, I want to restart my this thing, and I need a line to pay. You're already a good credit. You've never defaulted, but you shut down because of the macro realities that you were faced with. Just that process of kickstarting capacity. And these are the pent up. And so you are not creating new investments. So these are the pent up increase in capacity utilization, this output gap, which is why when you go through a decline in any economy, you see a bounce that actually overshoots your capacity before you then go to normalize. And in order for you to continue to grow, you then need to make that investment that expands your capacity into perpetuity. So do we really think that in the short run, we can have growth surprise on the upside? Absolutely.
No.
Absolutely.
When you say growth surprise, how do you mean?
On the upside. So like, can we get a 5% growth over a short period of time?
Yeah, short period of time is what?
5%, not 8%.
A few quarters. So 2-3 quarters of 8% is
5%. So you're saying like this 5%
year we could touch it. We could touch it and come
a few
back.
quarters and come back. Yeah, we can get it.
Like
that's feasible.
You just touch 5% and then you come back to your.
I really don't see that. But let's.
And you also have to guys remember that the base of output is now shrunk. So if Shell decide to do Bonga field and say it's $16 billion investment,
that quarter will be good.
Just deploying that money in that quarter alone we put a massive shock
So
on
we
output.
could get spikes. We could get spikes. Yeah, we could get spikes.
So the base is small. So growth surprising on the upside. I don't think it's as challenging as people are making it to be.
Yeah.
The real question is that can we sustainably increase our potential growth rate as a country? That's the one that is open for debate.
Because I
and
don't
to
see
do that,
for that.
I default to Dele's position that you need to open up the capital markets.
All right, talking about capital market. Another thing that happened last month was SEC. I think we discussed it a few episodes ago, but Sam is here and Tunji is here already. So, has there been any new development yet? They said they were going to release guidelines. I think they're still working on that.
Yeah, no guidelines.
But so far so good. How's the industry taking it? Are we now? Have we accepted it
moved
now?
on.
I think we're still
moved on?
adjusting.
Have the industry moved?
I mean, I think it's I don't know. It's for me. It's a case of we've had occasions now where regulators will come to the market with secular, and then they're having to pull it back to say, let us go and rejig it. Like those kind of rookie errors are things that are honestly, frankly, not acceptable. Right?
Yeah. Okay. So
it's not
errors. But what about the intent?
No. We'll get to that. What I'm saying is, first things first, what should happen in an industry when we're coming up with such circulars is let's secularize this with everyone. Let people give input, right? Yeah. Let's have a draft. People look at it and say, these are our comments, and then come out with one document.
Is there ever a time that doesn't happen?
No. In the last two scenarios that we're talking about, that hasn't happened.
How do you know that?
Because I know.
No, because
I speak to players in the market.
For example,
are you sure?
To answer your question, like as an asset manager, as a licensed asset manager, we have a lobby group which is FMAN, right? By definition, I'm a member of FMAN because I pay my dues to them. Okay. I can tell you categorically, the first call that FMAN had with regards to this was after the circular came out. FMAN were told that SEC was cooking something.
And
what SEC was cooking?
But SEC told me that they had an engagement with.
But yeah,
I don't know what
I'm talking from my own perspective.
There was an engagement to inform the market that this is coming. Yeah. There was no engagement to say these are the numbers.
No, but what I was told was that they showed numbers.
In the defense of FMAN, I know that there was an email sent to some FMAN members before. This was last year, and there a few questions were asked in this. There was questions about market to market, and possibly questions about recapitalization, but I'm not sure exactly to what degree. Right? But I think that this caught FMAN by surprise.
Sorry, are you guys saying that people in the industry
had no idea?
Did not know that?
So I cannot speak for the entire industry. Yeah. I can speak because this is a very sensitive conversation, so I don't want to say things that I will be misquoted on. I cannot speak for the entire industry. I can speak for my own situation, and I can speak for my industry lobby group, which is FMAN. I know, right, that FMAN was aware that there was going to be some level of recapitalization.
Yeah, definitely.
The quantum and the range was something that they were as surprised as I was when we received the circular. Right. And I was part of a meeting that was called, right, where this was discussed and the formal deposition to SEC was agreed upon. Right. That meeting should have happened when the draft was released. So not after it's been released.
Guys, is it normal for a regulator to tell you before it happens?
Yes.
Yeah, there should be a roundtable discussion.
Yes. No.
There should be a roundtable discussion.
That there's going to be a capital increase. Did that happen with CBN? Did CBN tell the banks? Did Cardoso tell the banks?
Yes, he did. November
that was going to increase, or was it not? Didn't we all just know?
No, it's not true. Cardoso had a bankers committee meeting in November.
Okay.
And he made it very clear at that point in time. And we'll come to banking and capital market operation because both two should exist under quite different regulatory regimes, right? So there is this. So at the end of the day, SEC is a stakeholder in the growth of this market.
Yeah.
Capital market operators are a stakeholder in the growth of this market. I think the regulation should be collaborative. there's always this perspective that I have with
Teachers,
regulators in
teacher
Nigeria,
students
where it's
relationship.
almost like police and thief. There's always this assumption that capital market operators are the bad guys, and we need to make sure that we stop the bad. And of course, like, I can't speak to everybody. There are bad eggs and there are bad operators in the system, and SEC is rightful to be concerned around the breadth of the capital market activities. And I know their intent. And obviously, Agama is also market friendly, because when he was put in there, a lot of people that I spoke to that know him very well were like, he's of the people that could have gotten the job. He's probably more receptive to market feedback than most, right? That was the feedback that I got when I asked questions around who. I knew who he was because he was the one that gave me my license when I applied, because he was head of registration at the time. But like, there were other people who were close to him. So the point that I'm making is, we all know, right, that this market needs to grow, right? We all know that the volume of players in the market is quite large, and we all know that there is a bit of a supervisory burden that SEC is having to endure, right? And we all know that the quality of capital market operators needs to be improved, right? The debate is, number one, there are processes around how you achieve this, right, that just doesn't center around capital alone, right? Capital, in my mind, is a very blunt tool that you use, right, without the need to do the really deep surgery that is needed to improve the quality of the asset management industry in its entirety. What you eventually do, for example, like under the current regulatory regime, a company like Zrosk could never have emerged. Where am I going to find $3 million to start asset management company from? Right? But I mean, especially within the equity market context, we've created a product in the market that the market seems to like, and suddenly we are the second largest equity CIS in the market within the space of 15 months. That's innovation. But in the old regime, in the new regime, I will have no chance to have come into the market.
Because there have been so many like that, and they haven't done anything.
So, but this is why,
like his example.
No, but this is why you need to ensure that you are licensing quality people, right?
Yeah.
There are lots of ways to know. There's fitness regimes that you can employ. There are systems that you need to ensure that people have.
Even
right?
when we've seen many times when the systems, you test everything. They say you have to kiss a few, what do they call it?
Because the challenge that you are having now is this industry needs innovation, right? And at the moment, 65% of the asset management industry is dominated by three banks associated asset managers. And most of these guys are asset gatherers, earn a fee on the assets, and are not really focused. I don't want to use the word "are not really focused," but when you actually look at the return to unit holders, right, that these people are getting, or the product innovation, because we always complain equity market is not diversified. We need more market participants in the market. Like the guy who is running an equity fund in a Stanbic or a UCAP or FBN, those are the three big juggernauts, right? They have so much capital in money market fund, earning their spread, that the time and the incentive to go and focus on deepening the market elsewhere is not really there. So you've now created a regulatory regime that suddenly strengthens these people's market power, right? And cut out anybody.
So if there was something we wanted to change in all of this, let's assume we have SEC guys watching, or people who are maybe on the other side. What would that be?
So I mean,
how can we make? Because I mean, the intent is clear.
Yeah.
So how can they make this better?
So the capital you need to put aside from an operating, because like, what risk do I face in my business, right? It's personnel risk. Do I have the right people, right?
Okay.
Do I have the right systems and technology, right? For the most part, my clients' assets are fully segregated. They are held in trust and with segregated custodian. So I'm not carrying the balance sheet risk on those assets.
Yeah.
Why do I need to hold 5 billion against that? And what is quite scary is the escalating capital profile that it creates for new businesses like us. So I'll give you an example. So under the old rules, we'll wait for the guidelines. You need 2 billion, right, to basically manage up to 20 billion. It means that let's say you start at 1 billion of assets under management as inception. By definition, you are carrying 2 times your assets as capital. Like, how much can you possibly make in that asset base to actually justify that capital investment. And then you are successful, the market is receptive to your product, you go to 20 billion. The moment you go from 2 times to 10% of your assets as capital, the regulator escalates you again to 10 billion, to 5 billion. And then from 20 billion, you then start, so 20 billion.
20 billion, talking about AUM now.
So when you are 20 billion AUM, you then need to hold 5 billion of capital. So you are then holding 25% of your capital relative to your assets.
But I thought they reduced that already.
No, they haven't. When you then get to 20 billion, right, you escalate to 5, and then you then start making money, and then your return maybe improves. When you get to 100 billion, you jump again to 10 billion. And then you then start accruing 0.1% of whatever AUM you get there. So it creates a huge disincentive to grow. Because at every time you hit a growth spot, your return collapses.
So let me ask you a question, right? If for some reason you have a very rogue asset manager and maybe investors lose their funds, maybe you have some like a made-off kind of arrangement, and then investors lose funds, what's the recourse?
What category of investors?
I mean, I'm just using that example now. So you have a fund manager who has maybe 100 billion assets.
No, but so generally, asset managers, generally, asset managers have segregated funds, right? The segregated funds sitting with a custody or a trust that is out there. The asset manager is the advisor on the funds, right? So in terms of Madoff, the Madoff situation, he was falsely reporting returns.
Yeah.
Right. He was taking client funds and falsely reporting returns. The regulator's job in that sense was to make sure that his reporting, his numbers were audited, right? Not that he had enough capital to protect those guys. The regulator should have made sure, number one, his funds were segregated, and number two, his returns were audited. It had nothing to do with minimum. It wasn't segregated, and his returns weren't audited.
Is it segregated in Nigeria?
It's segregated in Nigeria. Yeah, your custodian,
no, not
and your
necessarily.
trust.
The requirement is that you should segregate.
Yes, so it should be
segregate private funds. You should segregate mutual funds, and they should actually, your legal documentation should segregate, and it should be bankruptcy remote.
Yeah.
So my point is.
So let me ask my question.
I want to tackle your question. I know where he's going to.
Let me ask you clearly. So I'm a fund manager.
Because having minimum capital does not escape.
No, let him land.
So I'm an asset manager. I have 100 billion in assets.
Yeah.
Right. From in AUM. From different investors that I've pitched.
Yeah.
And let's assume my capital is just 1 billion or 500 million, right? But I've done so well, and I have 100 billion in AUM. And for some reason, I had a rogue head of treasury or whatever, and then my investors lose 20 billion. So what's the recourse here?
Capital won't solve that problem. 20 billion, even if you hold 5 billion against it, capital won't solve that problem. What will solve that problem is the regulator ensuring that I have the technology, I have the people, I have the risk management system. I'm not saying capital is not important.
Yeah.
I'm saying the quantum of capital relative to the economics of the industry is where I fundamentally have. So raising capital is not an issue. Raising capital, and you have to define where that risk lies. The risk that I carry. So for example, when I wanted to launch my fund, right, I filed a document to SEC. SEC rightly looked at the fund and say, you can't market this fund to retail investors. I agreed. You need to put it in a specialized fund vehicle for high-risk investors. Make sure the disclosures are clear. SEC should come back to me and say, okay, who are your investors? Are you ensuring that you have the right? Because SEC needs to protect the retail investors because they don't have the experience, right? Or they don't have the knowledge on the product. So if I'm marketing to a retail investor, the oversight that the regulator should have on that product should be much higher. But where I am then marketing to HNIs that understand the risk, or I'm marketing to institutions that understand the risk, what SEC mandates from me is that I am disclosing clearly what my investors are investing in and the risk that they are taking. Should my investor lose money as a consequence of my investment? It's not my responsibility.
The investor is aware of the
investor is
investment risk.
aware of the risk. Investor is taking the risk.
Yeah, so but what
unless there's an operational lapse in my execution of that mandate.
So what tends to happen in reality, Sam, is, and permit me for my ignorance, because I see a lot of these things. What tends to happen is that investors lose money, right? For some reason. Who do they go to?
Yeah, but all these investors, they go to all these shops where they'll say, I want to triple your money, right? A lot of those things in the market.
Who do they go to?
They go to SEC.
So the question is, SEC?
Let's roll back. Let's dial back. Let's dial back. We need to have a regulator who has a core interest in ensuring that the industry they are regulating is growing and that the industry is profitable, right? And I'm going to go back to the pension industry, right? As an example, right? In valuations in that sector today, if you want to buy a PFA, the price you pay is 10% of AUM.
Who came up with that?
That is what the general market.
Yeah, so there's no science to it.
That's what people are. That's the price people are asking for.
Is that really right way to value a company?
It's usually a percentage of AUM. Whether it's 10 or 5.
So today it's 10% of AUM.
It depends on your returns. If your returns are high and you are growing, then you can pay more. If you think you can get efficiency,
you look today is so. Access Bank bought ARM, right, and that was a 3 trillion naira asset. So give or take, I'm thinking in my head, maybe they pay 300 billion, right? Now I look at ARM's pensions asset today, right? And I'm saying I'm earning what? 1% of AUM is what I'm making as income. So basically, at 3 trillion, what I'm making every month, what I'm making as revenue is 30 billion before costs.
A year.
And I paid 300 billion for this thing. So 30 billion of revenue, at the time I start factoring in my costs, what is left on the table?
How much are you returning to your investors?
That's what I'm asking. That's what I'm telling you. You're missing the
point.
You're not asking me to go and look
for. What he's returning to investors has nothing to do with his revenue.
To your pension holders. Because
that has no revenue.
That's not the top line is the management fee. The top line is the management fee.
No, guys, listen.
It's not the revenue. The management fee is not performance.
PFAs and fat fees.
Do they?
What fat fees?
Can you tell me what the fees are?
What's regulator earning? What's regulator earning?
PFAs are on management fee now. PFAs make management fee. It's like 1%.
What's regulator earning? What's regulator earning?
Wait.
I don't understand.
Leave regulator out of this.
Oh, I mean, come on.
Let me ask my question. I'm a PFA. I earn my fees. I'm a pension contributor. And over the last 10 years, I have not seen a return that is above 10%.
Okay.
That's
wait.
Despite inflation and co. And you're sitting here worried about the return that is going to a PFA. And you're not worried about the return that is going to the RSA. Which one is more important to you? They are connected. So what incentive do I need to give a PFA to give an RSA a better return?
Can I say something?
How does capital solve that problem for you?
Can I say
then you're serious about your business. You just look for return. You just talk about return now.
How does capital solve that return problem for you?
Return.
How does that
already low now because so can I just say something? Can I just say 2 things first?
Let me add this bit. That's what I'm just saying. In that 10 years plus, right, that we're talking about that we've not returned over 10% to the customer. Every year, every PFA has declared bountiful profits.
From what? From a 1% management fee.
But you
Can
get it. A lot of them are loss making.
Can I say Can I say two things?
So why are they in the business then if you're lost?
That's what I'm telling you. So the moment, so now that you increase capital, you made the return on the business.
When are they
Why are they in the business?
now or before?
We are not. There are two dimensions to this, right?
Yes.
The PFA basically, the return of the PFA is the ability for them to aggregate the assets.
Yes.
Not necessarily the return that they give to the RSA holders.
Mm-hmm.
The question around return to the RSA holders, what you really deal with that is competition and full disclosure on the PFAs that are actually achieving higher return.
Mm-hmm.
So if there's clear transparency and you can tell RSA holders that Stanbic PFA consistently outperformed this PFA, right? And there's easy mechanisms for people to port their accounts from one to the other. Naturally, nobody wants to sit in a low return product and there's no gating. So what the regulator should do is reduce the friction that is required to switch accounts and increase publication so that people know who are the better managers to be able to
But they've
move
done that.
Right. So that's one. And then the second point I wanted to make, Ugo, because I want these conversations to be a bit constructive, not necessarily critical. Right. Which is always, okay, what should SEC have done in this environment?
That was why I asked that question,
right? There are quality spectrums in terms of, this is not, we're not reinventing the wheel. Like the UK went through theirs, India went through theirs. There are ways an asset manager or a capital market operator should be evaluated more than just capital.
Mm-hmm.
Quality of service, quality of systems. The regulator can rank us, right? And there can be a minimum cutoff point, right? That if you don't meet this based on these criteria, within a 24 months period, you lose your license. That will force people to make the necessary investments to be able to get to those quality thresholds. And you can do that without capital. And you improve the service delivery.
In terms of operational quality,
the risk that I have as Samson, right, is that I provide wrong valuations to my clients, right? I don't have the right people to make the right investment return for my unit holders, right? I don't have the right technology and systems, and then I fail my compliance requirements. Those are things that I should be evaluated on as a regulator. My regulator can rank me and score me depending on how I perform on those criteria, and you can rank the whole industry. These are information that can be easily provided and can be easily audited, right? When the industry ranking comes out, you can put us on a scale of 1 to 100, and you can say everybody below 50. If you don't get into 50 threshold within the next 2 years, we will not be renewing your license. That will force me. If I will look at the gaps that exist within my operations once I see that circular, right? I'll say, okay, I don't have a proper valuation system in place. Or I think the quality of my investment team is not high enough. I don't have enough CFAs. I don't have enough finance knowledge. Or I don't have enough experience. I can do that. I think I need to make necessary we open this conversation with the need to invest in technology in asset management. I need to invest in technology in asset management. These are the quality deliverables that I think will deliver the sort of asset management business that even the SEC will be proud of.
Before you continue, I wanted to ask a question. We do know Nigeria as Nigeria is. If any regulator were to create some sort of a ranking situation, where they
that's just a possible solution. There are different ways to skin this cat.
1 to 20. We do realize that what will happen, especially with our Nigerian, exactly.
Everybody goes to the one. What do you mean?
Everybody will just move to the 1, 2, 3, and that is on. No, it's
let's
just
customers decide.
So then I'm not saying customer is deciding. I'm saying if you as a regulator actively have a public scoring methodology. You are basically...
Doesn't even have to be public. You can send it to circular to capital market operators.
So the thing is, I don't think there's any regulator that doesn't have a metric in-house. If that metric is made public, either semi-public or full public.
See, as long as it is fair, as long as it is true, as long as it is not politicized. If SEC comes to me tomorrow, because every day we're trying to, we want SEC to be successful in its mandate. So a SEC can look at my operations and say, Samson, you are deficient here, here, and here, right? Obviously, maybe one of the reasons I'm deficient is that I don't have enough money. That's plausible. That's plausible, right? And I need you to close that deficiency within this time frame.
But they do this. All regulators do this. Maybe not in this format, right? But all regulators do this. We've seen it.
Because the point is like, okay, if we have, because one of the challenges that we have is that we have what 1,000 capital market operations. I don't know the numbers. Maybe Ugo, you would know, right? And there's always an argument that SEC is not large enough to have a proper risk-based supervisory framework around everybody. Obviously, there's a lot of things we can do with technology, right? For example, like a lot of reporting that we need to do. There needs to be a portal that is available that we can plug those reports into. Because sometimes you send things by email, you don't know if it's been received, if not been
There's
received.
also no standard of reporting.
For example, like I always see this mutual fund reports that gets reported. For example, like my Magna fees, I report them net of management fee and net of accrued expected performance fee, right? Obviously, I test for the trust language at the end of the period to decide whether that performance fee should be paid or not. You're probably
one of the only people that
but I've accrued it.
This way.
So my number is as clean as it can possibly be. I don't know if the other people that are being benchmarking are doing the same.
So this is my problem. This is my active problem with Nigeria.
And that's something I've always called out for.
We forget we have this tendency to forget a lot of things. That infrastructure you are talking about reporting, right? I mean, we had a conversation earlier about trying to build that infrastructure. In every other country, US, UK, right? The infrastructure was not built by the government nor the regulator. It was built by practitioners, just the same way.
But the regulator to a degree asked for a standard. No, but the regulator asked for a standard.
There's something called global infrastructure.
GIBS. Yeah. The regulator asked for a standard.
Let me say it.
So as a regulator, you ask for a standard, and as asset manager, I make sure my infrastructure fits that standard.
Just this. I'm talking about
if the regulator doesn't ask for the standard, the industry will never bother to work towards that standard.
So I'm talking about the inception of the infrastructure. The regulator can then keep the standard going, but every financial market
request for the standard. There is no need for any. If I'm reporting gross of
regulator,
Tunji,
there's no industry. No, wait. Let me finish. There's no industry in the world. There's no financial sector industry in the world that the start of the infrastructure build was done by regulator.
We are not asking the regulator to build infrastructure.
No, they won't build infrastructure, but they request for a standard.
Let me finish. Just
do you understand what I'm trying to say? They request for the standard, and then us as practitioners.
Just the same way banking in Nigeria, we were going at a steady pace, and most of you might not even know there was a time in Nigeria where if you opened a bank account in Bank A on Awolowo Road, you could only issue checks to that Bank A in Awolowo Road. Now, if Bank A existed in Kosoya Road, you could not go there. Now
we are comparing apples to
oranges. No, we are going there. I'm going to get there. Once
you put your money in that bank, the bank can choose to do whatever it likes with your deposit.
Let me say what I'm saying. Let me get to what I'm saying. There was a time in this Nigeria where the active members of what was called the Bankers Committee came together and sat and realized that, see, this thing we are doing is a problem. We need to create infrastructure that connects all of us together. It was the owner operators at that particular time that sat down and decided that we needed to create an infrastructure which eventually became what we call as NIBS today. Now, NIBS is as a private infrastructure as its own, was not created by regulator.
But we are not asking regulator to create anything.
Let me get there now. The reason why those guys could create NIBS was because, first of all, they had the cash. Two, they had the power to be able to speak it to the regulator to say, let us do it. Now, the reason why the capital market doesn't have the infrastructure to build that the technology can fix all these things is because not everybody has the cash to do it. Even if you sat down and agreed, do you know the amount those guys put together?
Can we calm down? This industry is already almost oligopolistic. You might have 1,000 players, but the assets are actually concentrated in a few people.
But they are not building the infrastructure.
So the question is, they have the cash to
build it. So why would they build it for you?
So why would they build it for you?
Hold on.
So that you can compete with them. So that you can compete with them. They will now drop the bar.
I had a shocker today, right? It's like I had a shocker today. So this was a snippet. This is a snippet into my show, Coffee Table. I had a guy today I was interviewing, and we were talking about credit bureaus, and I was wondering why credit bureaus wasn't working. And he says that you have a lender who lends money to Tunji. Tunji does not pay. Okay? So typically, what the lender should do is take Tunji's name and report to the credit bureau. And Tunji does not pay. Then, I now have an Otumba who pays, right? So if an Otumba pays, I take Otumba and also register to the credit bureau. But the guy says that's not happening. I say, why is that not happening? He says, because, same me, I don't want to write Tunji's name to the credit bureau because if I do, then Arnold will know that Tunji does not pay and Arnold will not lend money to Tunji. And Arnold will be making money. I want Arnold to lend money to Tunji, so Arnold will lose. Then I'll also not say that Otumba is doing well because if I tell Otumba is doing well, then when Arnold check and sees that Otumba is doing well, Arnold will lend money.
Yeah, but
to
the
Otumba.
regulator can mandate that everybody provide information.
So my point is that
what I'm saying, the regulator requests a standard.
There's no incentive to the big players to build it. So, but if
what I'm
you
saying.
capitalize the smaller ones, then they can come in and
if the regulator says
I look at that way.
If the regulator sets the standard, then everybody falls in place.
Remember we had a conversation. We had a conversation earlier. We had a conversation earlier. There is never a technology problem in any industry. There is a leadership problem. Now, the regulator...
Capital turn you into a leader when you know that what you have to do is raise money. Just raise money, keep it aside and carry on as you're going. Keep delivering poor service, keep having substandard reporting.
The regulator doesn't deal with your day-to-day activities. Your regulator doesn't know as much as you the API needs you have. The regulator doesn't have you are building you're talking about tech stack. Your regulator doesn't have those challenges. You see it real time. You know the pains. So when you are talking with a fellow fund manager about the same issue, you guys see eye to eye on how the solution can, how the problem can be solved. Also, not only that you have the solution, you also are willing to give your infrastructure over to the thing you are creating as the test subject to make sure this thing works, which is why the NIB situation was a perfect success. Not only because they had the money, but because they had the willing banks to plug into it to make it work.
Guys.
Maybe, I think
what technological,
so
let me ask you a question.
Yeah.
What technological advancement have we seen in the capital market space in the last 10 years? What's new that you, either for retail investors or for agent, what's the new thing that has come up?
In terms of products or in terms of service?
In terms of what you mean?
Service, whatever. Like, what's new?
I think my Magna fund is new.
And I'm excluding.
I think my Magna fund is new.
So you're not talking about products, you're talking about infrastructure?
Yes. And I'm
so you're talking about
and
infrastructure.
I'm excluding Bamboo and Trove from this. What
Something
exactly
that took us to the next level.
you guys have capital operators built?
What I'm
But again,
what we're saying here is that
capital,
the lack of innovation is not driven by capital.
It's not driven by capital.
So
what
what
we're
is
saying.
it by air?
No,
But
I'll tell you.
there are players that are big enough that have the capital to do this thing, but they're not doing
They
it.
won't do it because they don't need
But it's the
to.
regulators, they need to. The thing is, they need to.
But they have capital, but they're not doing it.
If you're not giving capital, I will do it.
Baba, calm down. Let me say this. You people are saying that there are people big enough to do it, they are not doing it. I would not lie to you. I am not one of them. But if I got there, not only will I not do it, I will ensure that you cannot do it.
But
you
if
that
it deepens your market position, if it deepens your market position,
it will not deepen. I will not give you technology to compete with me. It is leverage for you to 10x your productivity.
That's what I'm saying.
I will not do that.
Wait.
Why are we talking as if we don't understand business?
Why, if as a private market participant,
yes,
right, I realize that if I build a technology, I will be able to take Stambic's assets.
Yes.
Assuming that what drives the reason why I think technology plays a small role to why you would choose to be with Stanbic versus you choose to be with his Ross.
No, miss it. Let me give you an example. Sam, Bamboo and Trove were able to disrupt the retail stockbroker market because they had funding.
Is it technology?
Yes, even Rice Vest, even Piggy Vest.
So
because they have
can I explain something?
What is their market share still?
They have the largest market share retail-wise.
No, but what is that in our couple? What are you talking about? What is that in market share? Let's go there.
First Bank or in GT.
Let's go there.
Hold on. What do you want? You want a Stanbic or a First Bank or whatever?
I think we spent a lot on this.
To 100 trillion, but only have 1 million
Customers.
1 million people invest in the stock market. Is that what you want?
So guys, capital.
Yeah.
So has not prevented low capital adequacy has not prevented the origination of a bamboo or a trove. It is not because capital adequacy is low, is why bamboo or trove came alive. They saw a market opportunity. They convinced private market participants that they need to raise capital to go after that opportunity, and they did.
And they sought for it.
Suddenly, if you give Mama stockbroker the same capital that bamboo have, there's no guarantee they will create a product that will be as good as bamboo.
So why is
they don't have the leadership?
Why is Nicom recapitalizing? Why are banks recapitalizing?
So let me explain a huge difference between a bank and an insurance company and an asset manager is that the bank controls their balance sheets. For example, a bank takes deposits. It has obligations to satisfy those deposits when it is called, but it has the ability to use that deposit to earn an income. So as a consequence, you need to hold capital against the loans that you give, and when that depositor comes and collects his cash. So as a result, it's a balance sheet intensive business, and the balance sheet intensive business require a significant level of capital adequacy for it to properly function. Otherwise, there's a risk the bank will fail.
Insurance.
The second part is a bank has the ability to create money, which an asset manager doesn't. If a bank gives a loan to a customer and the customer immediately deposits that loan back into the bank has created cash overnight.
So how does an asset manager pay for an asset manager with a 500 million?
Can I finish, please? Can I finish the question? On insurance, an insurance company takes premium. An insurance company takes premium and guarantees that they will pay out should an event crystallize in the future. When they take that premium, they invest the premium in an asset. But once you come to claim, the insurance company has an obligation to pay.
That claim.
As a consequence, it controls that premium. It uses that premium to manage his liability book and hopefully earn a return from that premium.
So you don't believe, Sam?
Let's the last leg.
Let's wait for the last leg. What's the last leg?
Right. So as a
consequence, he said it's the last leg. So what's the last leg?
As an asset manager, I cannot create money. My assets are segregated. I don't have I don't have the ability. I cannot even commingle. For example, in my Magna fund, right, which is held in a trust. Right? My capital that I'm holding against that fund, I can't even pay it to the trustee. I don't even have a mechanism to move that money into my Stanbic bank account and send it back to the customer. And the person that is bearing the risk. So when I launch it, I have a prospectus. I have the presentation. You go and look at my prospectus. You go and look at my presentation. Say, am I comfortable taking the risk that Samson wants to advise me on? If the answer is yes, if that fund loses or makes money, my unit holder bear the risk. It's not me. A bank, if a bank loses money, the risk sits with the bank. If an insurance company cannot make a claim, the risk sits with the insurance company. If an asset manager loses money, the risk sits with the unit holder, not the asset manager.
So the unit holder, you and I that invest. It's all right. Let me now respond to him. Let me not respond. Okay, so your point is the banks that raise money and insurance company that raise money so that they can have that as a buffer for losses in case maybe loans go bad. I mean, capital adequacy ratio and all that. So you don't think that they raise money because they need to invest in technology? Because I see when they show us their prospectus of what they want to do with the money they are raising, there's an amount that goes into technology, There's an amount that goes into branch expansion. There's an amount that goes into going into other countries. There's an amount that goes into investing in human resources and staff and all that and training. I see that in there. They never tell me the amount that they are raising is so that they can keep it aside for in case there are losses. So, hold on. I allowed you finish. Stand down. Likewise, insurance companies, when they are raising money, they come, they tell us, we want to use the money to invest X percentage technology, usually mostly technology. And they want to reinvest in expansion, they want to invest in marketing, market share, and blah, blah, blah. So now, you guys are sitting here telling me that it is okay in 2026 for an asset manager not to have 3 or 4 Bloomberg consoles. You're telling me in 2026, and hold on now, an asset manager should not have, you know how much a Bloomberg console is? Hold on now, to tell me that an asset manager should not have 5, I don't want to call CFEs, chartered accountants. You're telling me in 2026, hold on, an asset manager should not have a full-fledged research team that pays for information. You're telling me in 2026, an asset manager should not be out there in the street like Arnold here, going to look for companies that you bring on the exchange to list instead of having 5 companies have 70% of your entire capital market. And you guys are sitting down here and you're telling me that you're
just so that will go to
capital
doesn't solve it.
Are you really
Capital adequacy. Increasing minimum capital doesn't solve it.
Why haven't you done it?
Increasing minimum capital still doesn't solve
it. Here's what I'm saying. Capital alone isn't a solution.
I never said it was a solution.
It's not.
But without the capital, I can tell you it is 10x more difficult to actually get there.
So we have multi-billion-dollar asset management businesses in Europe.
Exactly.
We have in UK. We have in the US. The minimum requirement
50,000
is
euros.
125,000 euros to launch a UCITS compliant fund in Europe.
Yeah.
Right? And then there's a regime to ensure that you cover operational risk. Second point, Ugo, if you look at a bank, if you look at the total assets of GT Bank, for example, right? 2025, we estimated to end at about 18.5, 18.6 trillion, right? The total PPE, which is the fixed assets that the company have, right, is 479 billion. If you go and tell it...
Sorry, could you...
So the total asset of the bank is about 18.5 trillion.
Yeah.
Right? The total, all these things you're talking about, people, branches, this one, technology, most of it feed into the property, plant, and equipment. Right? The total property, plant, and equipment that is sitting on the books is 479 billion.
Yeah.
The total equity capital that the bank has is about 4 trillion.
Okay.
Right? I am not telling GT Bank to hold, right? I'm not telling GT Bank to hold one. You know what I'm saying? Like the amount of money that is spent on these operational things relative to the asset base.
You're missing the point. Let me explain the point. What I told you is this. I said, what you're giving me now is GT Bank's net assets.
Yes.
Which includes profit that they've made for years, all packed in their retained earnings. I've got no problem with that. All I just told you now is that, and I can show you a prospectus. When I open a bank's prospectus that wants to raise money, and I want to know, the number one thing you tend to always go to is utilization of funds. I never see I'm raising money so that I can pack it in case I lose.
No. But the reason why there is regulatory, the reason why there is regulatory capital.
That's
the primary reason why a bank holds regulatory capital is its balance sheet nature.
Yes,
it's not because of its technology.
But I'm telling you that we're talking about capital raise here, and I'm telling you that the capital that you raise, that capital that you raise, right? A good portion of that capital goes into the technology and risk management framework that ensures that you protect depositors' money.
Can I ask you a question?
Can I ask you one question?
Why does an issuing house that doesn't underwrite need 2 billion naira?
Why should you not? What do you mean?
What
by
is an issuing house that is based on
what's the job of
intellectual
that?
property
What's
only?
What's the job of that issuing house? What's the job?
Just to bring this to the market.
Bring what
Bring people to the market.
Okay.
IPOs, whatever.
How many IPOs have we done?
But does capital
And
make
they
them
ask you,
bring
do you need capital to bring IPO to the market?
So why are we there?
If I give you 10 million naira, if I give you 10 million naira, you will bring people to the market.
We are
I don't understand.
We are
Okay, so why are they
conflating.
there?
We are conflating something.
See,
Hugo.
my point is
Leadership.
We have an underdevelopment of
the
our
market.
market.
exactly.
That's different from
Is that what we're
capital.
talking about? Okay, so why do you have an issuing house?
And you need to diagnose why
Yes.
we have an underdevelopment of the capital market.
Yeah.
I don't believe that having a bunch of 50 overcapitalized capital market operators will suddenly bring this market back to life.
Okay.
So
Why don't you
there,
think so?
there are areas where, for example, like the macro regime that we've operated on in the last decade has been largely fiscal dominant, and as such has created a huge disincentive for anybody to take risk.
Yeah.
There is no amount of capital technology that you will deploy that will change that.
Yes.
Obviously, the macro regime is shifting.
Yes.
We will see an increase in risk-taking as inflation normalizes and rates come down.
Yeah.
It is not because of capital that will change.
Mm-hmm.
It is that when you actually look at how returns, and because of the level of fiscal dominance that we've had, it's actually been the right strategy outside of the last 2 years to have packed your money and your assets in fixed income.
Mm-hmm.
The capital market, the asset management industry is growing, right? Even listed CIS is over 7 trillion today.
Mm-hmm.
So the market is growing. It's just that the market doesn't have the vitality that we want it to.
Yeah.
Some of it has to do with the macro regime. Other part of it, let's talk about the equity market today. I trade the market, an in and out transaction in the market cost me 1.5% of my capital.
Mm-hmm.
Right? Most of that goes in regulatory fees that I pay to SEC and stamp duty and NGX and CSCS. Right?
Mm-hmm.
How can I have liquidity when anytime I buy and sell a stock, I lose 1.5% of my money?
Mm-hmm.
Right? So, like, we are running this capital market like we are extracting rent, just like we are running the rest of the economy, where everybody puts their mouth in the small pool that we have and keeps transaction friction. A large reason why we don't have the level of transaction intensity in this market is that the market friction is too high. That's one. Another point is there's been a lot of companies that have come to the market to list. Yeah. We have this concept called listing by introduction. Yeah. I don't know what it is.
It's absolutely terrible.
Right? Somebody comes, does the presentation at the NGX. There's no price discovery. 100% of the asset is controlled by one or a close group of people. Yeah. They list the business and they say they've listed. There's no requirement to go and speak to other asset managers to deepen the market, right? And then suddenly this company is listed. It's a zombie company.
But is there any law that tells you not to bring an IPO? Is there any reason why you do?
So the reason,
because to his point, why are your issue now being up?
So let me explain. I'll come back to that. Yeah. So what have we had in Nigeria over the last decade? You've had the best bank in the country trading at half its book value.
Okay.
Right? You've had Nestle, one of the best run consumer companies, trading at sub-single digit PE. You've had MTN.
Nope, not Nestle.
Go and look
except for when they had their losses.
So let me land. Okay. So there's a huge part of the cost of equity that drives decisions for people to do IPO. So if an issuing house, no matter how much capital you have, no matter how many CFA you hire, if you come to me as an entrepreneur that is building a business largely from internal generated capital because equity is too expensive, and you come to tell me, like, for example, you go to Tosin that has spent all this time building money points to the institution that it is today, and you tell Tosin that the valuation that he can get for his assets cannot be more than what GT Bank is producing, which is the best-in-class player, because that is how these things will get benchmark, right? Tosin will tell you, sorry, I will use my internal capital to continue to grow. The only time the conversation change, and no amount of valuation, no amount of CFAs, no amount of capital will change that decision function. It only makes sense.
Whose fault is that, Sam?
It is the macro situation in Nigeria that is the problem.
That is not true, Sam. The reason why your capital market, the reason why stocks, solid businesses like GT Bank have valuation multiples or earnings multiples of max 4x, 5x in this market is because all of you here, you issuing houses, don't have the liquidity to drive the market.
No, cool down. No. It's a valuation problem. Issuing house don't buy stocks.
You don't buy stocks. Why should you buy stocks? Who's meant to buy the stocks?
Asset managers,
that's why I asked you. So what are the issuing houses doing then?
Their job is just to bring the deal to the market.
So why are they not bringing deals to the market?
Because I just explained to you.
So why does it work now?
Let me give you a question. Hold on. Nairametrics today. Hold on. Today. You own Nairametrics, and I tell you that I want to bring Nairametrics to the market, right?
Yes.
Nairametrics, you don't have buildings, you don't have printers, you're an online business. What am I paying for? I'm paying for your intellectual. I'm paying for your mind. That's what I'm paying for, right? So I can value Godre's business now at 100 billion.
Yeah.
But I cannot put assets to the extent that I can value. That's maybe our saving assets is 2 billion, right? So that's the same thing.
You're missing the point.
An issuing house is just me. It's just Dele coming to Godre to say, Godre, I want to list your business. Yeah. And you say, I look at your business and I say, you know what? This is how we can list the business. This is how I can market it. That is my job. That job is intellectual. How is it that? That job is intellectual. Why do I need capital? Why do I need capital to do that?
I want to tackle that.
How is that an issue? How is it that in this same market, in 2006-07, we had all sorts of companies list on the exchange.
You just answered my
valuations that are multiple.
You just answered my question.
It wasn't like the macros were so great.
It was.
As much as it was good. But no.
It's not just macros, it's cost of equity. See, for example, if you come and meet
guys,
can I
see, Sam, let me land. You answer. Wait. There are a lot of people today with cash. Sitting on the sidelines, Arnold.
Yeah.
They have cash. We just said they're 140 trillion. Sitting on the sidelines.
Not deployed.
They don't want to get into the stock market because they feel like they can't trust brokers and everything that happened because of the scam of 2007 and 8. That is the problem. And the capital market operators of today haven't done anything to solve that problem.
What does capital solve? How do you solve that with capital?
I don't care. Whatever it is that needs to happen to solve it. Because without demand, you're not going to see that liquidity.
I think we are having a definition problem. Capital market operators are intermediaries.
Yeah.
They are not ultimate risk takers.
Exactly.
No, I'm not talking about risk taking.
No. Because let me finish. They are intermediaries. If you don't have a value to intermediate, you can have all the CFAs
in the world.
You can have all the capital in the world. There will be no value to intermediate. So, for example, if you come to me, the reason why people were listing in 2006, 2007 is that I know that if I sell 5% of my company, I can invest in that plant that will create value more than the 5% that I've given away.
Because share prices were high.
So that is why the cost of
There's
capital.
There's a demand problem you're not talking about here.
See, it's a cost of capital thing. I'll explain why it's a cost of capital thing.
Who the hell is talking about cost of capital? It's a demand issue.
Can I ask you one question? Let me finish. Demand is reflected in your cost of capital. And I will explain. This same market, right, that we think like it's a dead market.
Yeah.
It's the same market that Okomu went from 30 naira to 1,006.
Thank you.
It's the same market that NASCO went from penny stock to 100 naira stock. So the point is, markets, right? No matter how much you try and say is innovation, is this, what drives value in a stock market anywhere in the world is growth and return on invested capital. Nigeria has not delivered growth or return on invested capital over the last decade. So it is wishful thinking to think that people will just come and be buying stocks for that reason alone.
So can I ask a question? 100 million fund that you run, right? 100 million naira fund that you run. Is it going to have the same impact, products, and productivity as the same fund which you run at 1 billion naira, your business right now, 10x your capacity in terms of resources.
Yeah, capital doesn't make me 10x my capacity.
No. I'm not saying capital does.
Of course, I want to run $1 billion.
No, wait. I'm saying you today.
Yes.
10x your resources. I'm not saying just your investment or your resources as a whole. Your capacity.
So there's a reason why.
That are there,
so let me explain. Let me explain something.
Uh-huh.
There's something about our business and why, very intellectual type of people like it.
Yeah.
Right. Is that we have this concept called operating leverage, which is once I build my team, once I build my technology, once I build my platform for scale,
you can grow.
Any incremental asset that I add on top of it doesn't require me to make additional investments. Yeah. I just need to make sure that I have a minimum standard that is high quality. The regulator can drive that standard. But saying that, because Samson is now managing, can I finish? Because Samson is now managing 1 billion, he needs to hold $100 million in capital.
You have still not answered my question. You have still not answered my question. Now, 10x your resources.
Why do you 10x your resources? Why do you 10x the resources?
Why can't we just answer the question?
Why do you need 10x the resources?
I don't need 10x my resources.
He's not doing retail.
Let's move on.
He's not doing retail.
I don't need 10x my
Let's
resources.
move on. That is why we're here. Guys, we gotta move on.
Now,
10x my resources is going to result in significant decline in my return expectation. And I have shareholders at the end of the day.
Exactly.
I'm not running a charity shop.
Wow. We gotta move on, guys. We gotta move on now. You can see it's a hot debate on. It's not every time we have this, but interesting debate. And I'm sure you haven't seen the end of this debate. We're going on and on and on and on. At least Arnold has just been like, he's not really sure where to be, but let's leave that.
But I think to end this conversation.
Yeah. But I wanted to know what your final suggestion is.
So end this conversation. I get that we need to improve the capital market.
Yeah.
I think the macro environment is supportive, right? I think the regulator has an intent to improve the quality of capital markets participants.
Yeah, 100%.
100% agree with that view, right? I think capital alone is a blunt tool to be able to achieve that, right? There is a lot of quality gaps that exist and there is a lot of qualitative work, right? I think in our kind of business, the fact is the market return determines the winners and the losers. It's not capital. There's a reason why Berkshire is what it is. There's a reason why Breven Howard is what it is. It's not because of the capital it has. It has made commitments to his investors. People believe them and they bring capital. That is the value proposition that we have. My regulator just needs to make sure, right, that I am saying what I'm doing, what I told my investors I'm going to do, and I am not lying, and I have the process to ensure that my operations work.
Easier said than done.
I'm just
let's move on.
I pay SEC 25 basis points of my mutual fund every year. Their regulatory responsibility is not supposed to be easy, just as my job is hard. The regulator's job is hard too.
Let's move on, guys.
You cannot put the building of the industry on the regulator. There's no financial sector
you want
in
the
the world
regulator's
that has
job
built
is
the
hard,
regulator.
but the regulator
that is built by the regulator. There is no industry.
I think what we need to say is that the regulator does not have the capacity.
And it's not about the capacity.
No, the regulator does not have the capacity to oversee the industry. As such, they want to reduce number of players.
No,
period.
that's not
So
it.
let me ask one last question.
No, that's not
Tunji.
it.
Do you think that the industry today has performed beyond your expectation in the last 10 years?
No, now we cannot
course
lie.
not.
There's no industry in Nigeria that has performed beyond expectations.
Of course not.
There's no industry in Nigeria. There's no industry in Nigeria.
You will allow me answer. You know it has not.
There's no industry in Nigeria that has
let's
performed.
move on,
Nigeria
guys.
was a basket case that we are trying to recover, and we're in a macro recovery.
Yes.
Any industry.
And you don't think if everybody has taken an adjustment, you don't think operators should take an adjustment?
Again, I am not against an adjustment and improvement. Again, I have like I'm not.
All right, so that's clear.
I think I have an issue with the quantum of the capital, and then the cliffs that exist within that. Right. That's what I have to tell you.
That makes sense.
When you look across Nigeria, Nigeria has let us down.
But you're using a one size fits all argument because everybody listening to you will think that you are saying do not increase capital requirements.
Nigeria has let us.
No, he didn't say that, but it does sound like that.
Just saying the quantum.
No, he's just saying the quantum now. No, they were arguing together. So
Nigeria, Ugo Dre, this is your argument that the industry has not done well. We've all look at the banking industry. Has it done well? Look at oil and gas. Has it done well? Look at manufacturing. Has it done well? Nigeria has destroyed capital at a scale that is insane. Wow. Let's think about it. These valuations that we're talking about, market is up 100%, 200%. We are getting back to prices that
we're not even there. We're still below.
At the time when I launched my fund, right, the collective profit pool in the banking sector in dollar term have gone up 3x, but yet the valuation was 80% down. We have not recovered.
So for some fun fact, I did some research in 2000 under SEC in 2000. One of the DG then they increased minimum capital from 3 million to 20 million. You know how much 20 million was then?
What was it?
And this was for brokers, I think.
So 20 million in
this
2000.
$2.5 million.
20 million.
In 2000.
In 2000.
Yeah.
25 years ago.
Yeah. Just some
context. This is Nigeria.
And in 2008, we also they increased.
This argument we're having now is partly because of poverty.
We're in a different global macro environment. We're in a different macro environment.
I think for me, the biggest risk to this regulation.
I remember Otuma told me some stories about his time in the market, and I'm sure if these conversations are happening at that time, Otuma was like, "Let's go, let's move." And the market velocity is also not there.
Talking about gainers. So I was looking at the top gainers year to date, and I don't know if this is also reflective of what's going on. And the top gainer this year so far, I know the year is still early. Score 345%.
Who?
Score. Morrison 274. This is the numbers that I have here. Deep Capital, RT Briscoe.
Why are you asking? Are they listed in Nigeria?
Those tiny micro
six
stocks.
Agro, NCR, Multiverse, DAR, Mignose, Red Star.
Well. Wait,
these guys have done 90 and above %.
DAR?
Yeah, but can you get in?
DAR Communications?
Yeah, AIT.
They're still there?
No, they're still
I think macro stocks that drop of 1 penny, the penny stocks, right? Kobo stocks.
There are lots of...
so in terms of return, I mean, like...
but can you buy $1 million of Soccer?
Wow. Is one of the oldest companies in Nigeria, by the way.
Yeah.
Yeah, but I mean, it's market cap, liquidity.
SCOA.
They're not a Square Motors.
S what?
Square Nigeria. They are one of the oldest companies in Nigeria.
I only look at the NGX.
I'm just telling you.
I was saying earlier today, right?
That your
we are so
podco should
fixated
list
on
too.
market went up 50%.
That your podco.
Which one?
The car one. Should list because I'm telling you.
Square is in 3%.
Your podco should list. No, serious.
But can you buy? Can you buy that stock? Can you sell?
Because
can you buy
can
and
see
sell
all
that
these
stuff?
things that we've said here.
People
Me,
are
I
buying
want
and
to
selling.
I want to list our bar. All these things.
No,
but we will list.
No, but let's be realistic.
I don't
as
know.
well,
The
right?
point is, we need to get valuations to a point where listing becomes attractive.
Yes.
At the moment, listing is not attractive because the amount of equity you will need to give up for the capital you will need to raise is too small.
And also to a point, just to play devil's advocate, that's why I suspect that's why quite a lot of people are doing listing by introduction, because what valuation would you give me if I come to list?
Yeah.
Right. You're pricing me as a distressed asset.
You know what someone told me who listed recently, and said when a company lists, not the person who listed, but people around, those who listed, and said when you list in Nigeria, to defend your share price.
Why do you need to defend your share price?
Yeah, because to your point,
nobody
price
is there to
is
support.
not the same thing as value. you know that your share price, you and I sit down here today, we know that GT Bank is worth 200 naira. You know that deep down.
Yeah, but that's why I'm long.
Exactly.
And then, so everybody.
Now.
But if GT,
are we
basically sanctioning market manipulation?
I'm getting to somewhere.
See, the underwriter should keep buying the stock until it goes up, right? I know where you're going.
You don't know what I'm saying. Okay. You don't know. Don't assume you don't know where I'm going to. Okay. So we know that GT Bank is worth 200 naira today.
Yeah.
That makes probably what 210. But today these guys are what 100 plus. And the reason why their share price is depressed is not because of their value, it's because there is no demand.
Yeah.
Demand is a huge function of price. So where you have a market that you don't have enough demand, prices tend to go down. And it's not because the value is not there. Today you have Nvidia and most of this stuff trading at 40 times, 50 times.
No, disagree with what?
So the concept of demand and value.
Yeah.
Okay.
So
demand and price, value, demand, price.
One of the reasons. So when you have a 30% risk-free rate, for the sake of argument, right? It means that if you put a 30% risk-free rate plus equity risk premium plus beta into your model, once you go more than 1 year, 2 years out, the value of everything else is zero. There's no reason to take any duration risk. Equity is the longest duration instrument you can buy, right? But when your short-term interest rates are in the moon, nobody takes duration risk. Nobody even buys long duration bonds. And the behavior we're seeing in the market over the last decade is that no one took duration risk.
So your point is that, hold on, your point is that because interest rates
high.
20,
treasury bills are high. There's no need for you to take equity risk. When you can get 25%.
But fun fact. I have seen interest rates as single digits in this market, risk-free interest rates. The stock market is still down.
But again, you need to look at why interest. You need to look at why interest rates are where they are. The sustain. When Godwin engineered interest rates,
forget Godwin.
Can I finish? Let me. So the last time we had really credible inflation targeting exchange rate regime, we had a bull market. That was under Soludo. Market went up because people believed that the interest rate was credible, inflation was credible. What Godwin did when he banned local investors from buying Omo, he created a liquidity deluge that depressed the yield curve over a short period of time.
But you think it's both are right. They're both right.
This is not about theory. In this market in 2005, 6, 7, 8, 9, 10.
But
I don't know where you guys were
but
I was in this market.
What happened to you?
And I was buying. I was buying because there was demand. This was not about interest rate zero. I don't even know what the heck was going on.
You don't buy because of demand. You buy because of value. You don't buy because of demand. What is the concept of demand? Demand comes because value exists.
You're just talking about
opportunity.
The value in the company then drives the demand to want to own the stock.
You just complain now.
Then I cannot say Dele, I want to go and take
you just complain now
to buy shares.
You just complain
Which
now.
was what they did, and then they blew up.
You just complain now that companies are not listing because there's no value. Oh, I'm not going to list because if I come on list, there's no value.
I will not get the valuation that I want.
Hold on. And I'm telling you that the reason why they won't list is because you have a GT bank that should be valued at twice what is valued today. That is valued low. And I'm telling you because there's no demand in the market. And you're telling me it's interest rate.
The reason why this same GT bank that is undervalued, under a stable macro regime, is going to trade at 2.5 times book. The same market. This same GT bank used to trade at 5 times book in 2008. The same market, the same investors. The reason there's no demand, and quite frankly, it's actually been the right strategy that when you had the level of financial repression that we had, right, it didn't really make sense for people. If you had bought these assets, you would have lost money. A few of them, maybe like GT, compounded through the cycle. But go and look at like the way I look at returns in bank is the growth in the book value of the bank plus the dividend paid. Look at it through the cycle. That's how you know the banks that generate value over and above cost of capital. Go and do that analysis across the bank. I'm sure only GTB would have generated a return that beats risk-free rates over that period in the entire banking system. So you now ask that guy, right? that said, you know what, subconsciously decides to buy T-bill, he's made the right investment decision. But you're like, no, GTB is undervalued. Of course, GTB is undervalued or Access Bank is undervalued because when you actually look at the value that it returns to you, which is the growth in the book value plus the dividend, is not meeting my hurdle rate.
What is the point of dishing out 30% return on equity year after year, and my dividend yield is sub 10%?
So again, that is why.
What sense does that make to retail investor?
That is why I say. That is why. Well, it depends.
Capital.
What sense does it make to
capital preservation?
There's what?
Yes, because
what? In this same market that you just told me now, that exchange rate.
Hold on, no. When I mean capital preservation is that, and international, you see, the local market, what the local market like, want to see dividends. That's what they want to see, right? But guess what? But the international investor is going to tell you, as opposed to tell me to come and give you more money to come and do rights issue or go and do capital round. Hold back your profitability and grow.
Yeah. So that's what I'm telling you.
So we have to then find a way. You have to then find a way to find a middle ground where local and international investor are happy. So that's what drives your division.
I've owned the stock 10 years. To Sam's point, you've returned 30% return on equity. That company does 30% return on equity year in, year out. 20%, 25%, it's fine. Wait. Mm-hmm. I've kept that stock. All I've gotten is 5-7% dividend yield. I haven't seen capital appreciation dollar adjusted. So what's the point?
So can I explain? So the thing is this, and because we operate in Nigeria, there is a lot of money illusion that is happening. So the concept of, and that's one of the work we do internally at Rusk, right? The concept of return on invested capital and ROEs need to be adjusted for real. Equity markets don't react to nominal ROEs, and I will explain. If you build a plant, right, 10 years ago, and you fully depreciated it because you are also in a high inflationary environment. So you built it in Naira terms in 10 years ago, right? You are now earning from that plant today, Naira. That earnings you earn this year is a real dollar, right? But the denominator, which is your capital, is a historic Naira value plus depreciation, right? So your ROE looks optically interesting, but the reality is that it's not a real ROE because the economic value of that Naira that you're earning has been eroded. I don't know if that makes sense. Mm-hmm. So a lot of Nigerian companies, when you look at them, optically, they look like the ROEs are super, super high. So some of the work we do at Rusk is to adjust the balance sheet value of these businesses, assuming that you are reinvesting in them today. So like say Nestle, we assume that, okay, Nestle is rebuilding all its plants in today's constant currency term. Yeah. And then I will now look at the real earnings that Nestle is generating today and say, okay, does this return meet my return on invested capital hurdle rate in real terms? Companies that are able to demonstrate real economic value addition, regardless of macro regime, outperform. This is science. This is like...
I understand that. So my point is that a company outperforming is also different.
So the reason I was explaining to you, is that you can have a company that is having paper ROE that is high, but economic ROE is useless. So again, it's not a question of do you really... So there are probably like 2.5 banks. I always say this, that when they tell me this is their ROE, I actually believe it's their ROE. If that ROE is not cash that you can distribute. Remember, when a bank declares dividend, cash leaves the institution.
Exactly.
So you can have paper profit, right? Yeah. And you don't have cash.
Don't have cash.
Right? Very few of them, I don't want to mention names, with that paper profit and cash correlate. So that's why you can have that ROE that is high, and then you're having low dividend yield. As an analyst, our job is to figure out what the true ROE of these businesses actually really are.
This is across all banks. Is there any bank today,
GT Bank,
that can give you a dividend yield
GT Bank
of 15%?
Yes, GT Bank.
It has not happened.
Zenith can.
It has not happened.
It
can.
They can, but today. So I have. Okay, for example,
they can.
Can I? Ugo,
it has not
these
happened.
are important
I'm
conversations.
just trying to we're trying
These are,
to we're trying to align.
no.
Hold
These
on,
are these
hold
are
on.
important
Yeah.
conversations.
I just want to. You said must day, so I'm saying that
Mm.
what we're looking at now is we're all looking at why.
Because
We're
we're
not
moving
seeing
post, though.
people get into the
We have
capital
gone
market.
away from capital market.
That's what I'm like.
No, but
Because-
that's where he's
No,
driving the conversation.
no,
to.
We're talking about
same
why
thing.
the capital market is underperforming and capitalization and all that.
Yeah.
Yeah, and I'm trying to explain my demand position.
Yeah.
And I'm saying that I invest in the company for two reasons: dividend yield, capital appreciation.
Yeah.
That's why you invest in
I
any
didn't
company
know.
anywhere.
Okay, maybe love or something. But
No, that's
like,
why you.
That's like a third love.
No, that's why you as an investor.
A far third,
Yeah, that's it. Except you're controlling the board or
something,
whatever,
yeah.
and then you're controlling what the heck is going on there.
Yeah.
But if you're just distant, you're not on the board, you're not a majority shareholder,
You just
you're just there
participating
for
in shit.
dividend and capital appreciation. And I'm telling you that if in this market there has been no dividend yield for some of these big banks, if not all of them, that is above 10%.
So I don't.
And then with capital appreciation, that if you adjust, which is what we've said, for
I say
all
growth
the
in
shenanigans-
book value, not
Yes.
not capital appreciation. Growth in book value. So
when you say growth in book value, I'm not talking about the company.
so
I'm talking about as an
so the
investor.
value creation in a bank
Mm.
is basically how much book do you start with? How much did that book grow by?
Whose book now?
The bank's book.
That's what I'm saying. I'm not looking at the bank's book.
Yeah.
If I look at the bank's book, it's doing well. I have no problem.
But you're looking
I'm
at
saying
your
that
capital.
as an
How much are you
investor,
getting?
You don't really-
and I'm
yeah,
telling you,
your price
this is what
appreciation.
determines. We're actually talking
Yeah,
about
okay.
what determines
So
whether
valuation
somebody
and
wants
its
to
price.
invest somewhere or not.
And he was talking about demand.
Yeah,
earlier.
what makes a market attractive to
flows.
people?
Okay.
Yeah,
And I'm telling you that
flows.
if investors are not seeing higher dividend yield or higher
gains.
capital appreciation,
Yeah.
then
One has to happen.
So the capital appreciation. So if you're normally if you
Yes,
are
I see your
retaining
point.
more earnings
Yeah.
and you're compounding those earnings at an effective real ROEs, your capital should appreciate. If it's not, that's a value gap that is existing, and your work is to try and figure out why that value gap exists and whether it
you're
should
coming
close.
to my point.
So that's one.
So
So
what's
who's
that
that
one?
one?
Who's to do that one?
Okay, wait, as an investor. And then secondly,
No, you're just opening
outside
a
of
gap.
2023, 2024, which had significant level of FX revaluation losses that were like a bank like GT and Zenith GT distributed up to 60% of its distributable income after you account for statutory deduction. That is a high distribution rate. That it wasn't a 10% dividend yield, it's also a function of the price that you pay at entry into the valuation.
Yeah.
For example, when I started buying GT, it was trading at 17 naira, right? Today, if it pays me 12 naira in dividend, I'm getting almost a 80% yield on my investment because I've taken a view.
I want dollar adjusted or naira?
Cost
Naira for naira now.
You have to adjust it now.
Constant currency.
No, I
Yeah,
invested
It's a
naira
Naira
now.
fund now.
I invested naira.
It's a Naira fund.
Naira fund now.
Guy,
Yes,
in
Naira. Why did you adjust it?
October,
So that 12 naira
in
that you
October
get, can
2022.
it buy you what 2 naira would have gotten to you?
So
before?
let me ask you.
Okay, so you're
Ogode,
adjusting.
Yes, now.
let me ask you a question.
But I
You're
get your
adjusting
point,
inflation
though.
and not
I get your
currency.
point on
You
that.
have to adjust
So
inflation,
let
not
me ask you a
currency.
question.
Yeah,
So
yeah.
today a bank
Wait,
pays you.
what?
A bank is paying you
Inflation, not
15%.
wait.
A bank pays you 15% every year, right? For the next 3 years.
15% in what? That's what?
Dividend yield,
Yield.
right?
Yeah.
And then on year 4, they tell you want to do a capital raise.
And collect all the money back.
I
from
collect the
you.
money back from you. Is that what you want?
So
What the banks
I'm
have
trying to
done.
understand the
No,
sense
that
of
was
what you
capital.
just said now.
Now it's a capital raise
What's the point?
conversation.
So-
What does that
Now it's a capital raise conversation.
What banks typically do is they would pay a sensible dividend and retain capital for growth.
Yeah.
There's nothing
Right?
wrong with
So
that.
so that way they don't have to come back to you every time for more capital to
And in
grow.
a functioning
See,
market,
you're missing
that
my
retained
point.
dividend should appreciate your capital
so
base.
you guys are
right?
missing my point. I just said there are 2 reasons why you invest: dividend or capital appreciation. I've owned, for example, Meta stock for the last 5 years plus. I don't even know whether they pay dividend because I really don't care about Meta's dividend. Meta's dividend would always give me 1 or 2% dividend yield. Microsoft, all of them, I own the stock. But when I look at my capital appreciation for owning those stocks, they have done very well, adjusted by any measure you want to talk about. And I'm telling you that here in this market today, you're not getting that return on dividend. Neither are you getting that return on capital appreciation.
You are.
So I'm saying that.
I mean, my fund did 73% last year. The market, let's ignore my fund. The market did 48% last year.
So last
the year before, the market did 30-something%.
So why are people not listening? But you just said companies are not listening
because we are still because what we've had, and these are good questions. So Nigeria has gone through a macro adjustment. The entire corporate balance sheet in Nigeria is adjusting to a new macro reality. The companies that have dollar balance sheets is adjusting to the new naira value of those dollars. The companies that have pricing power are adjusting their pricing to adjust to the new macro reality. So what we are seeing in Nigeria, despite the increase in the share price, is a nominal adjustment of share prices to catch up with our current economic reality. Multiples haven't changed. When I started looking at Nigeria aggressively in 2002, 2003, it was trading on 5-6 times PE. Today, it's still trading on 5-6 times PE.
Correct.
Right? At 5-6 times PE, right? If you go and raise significant amount of capital at that price, you will suffer a lot of dilution. And the value you will create from that capital will be such that it will not create economic value for you as an entrepreneur. An entrepreneur wants to be able to raise capital, give a part of his company away, right? But that money will create more value than the part that is giving away. The way Nigerian equity is currently priced, which is why it's important to start this investment cycle that I talk about, is such that the incentive to use the capital market as a vehicle to raise capital and the value that capital creates doesn't work. And the reason why is because your cost of capital is too high. And your cost of capital is too high because your inflation is too high. The inflation is too high because of the macro distortion that we're talking about.
You know, I disagree completely with you because I think you're mixing a lot of things together. We've been in this market with all this grammar we're all speaking. We've been in this market. Peak investors come. What's their AUM? They always announce how many people have come in and how many investors they've been able to bring in. We've seen Bamboo, they've done their own. We've seen OP, they've disrupted the entire market. You've seen what they're doing. You've seen several players come in. You've even seen in this same market, you've seen agrotech people raise billions of capital.
Who funded
Nigerians, retail bank. So people who lost money. All these retail guys. Wait. We know a lot of agrotech people. People who invested in either agritech funds and also all these fake returns they were distributing up and down. In this same country, people have invested in crypto. Nigeria, they say is the second or whatever crypto capital of the world or dead or whatever. We've seen it happen here. So my point is that, guys, what we're missing at the end of the day is we, and I say we because I believe I'm part of the entire capital market ecosystem, we're not doing enough
to create value,
to make our market attractive. And it's not going to happen if we sit down here and think macro has to be fixed for that to happen. It's not going to, because this is a chicken and egg situation. Which one comes first? That's my point here.
It's a combination of both.
Yeah.
So you're not going to wait.
Macro has to work.
Macro has to work.
Which one comes first? That's my point.
Macro was bad.
The NGX needs to feed. The NGX needs to.
No.
Macro was bad.
But you know what? But crypto was an outlet.
I would disagree with you, but you mentioned some good points in terms of quality of companies. Macro was bad, but these guys are raising an interest evaluation.
Yeah, but the reason why they were raising is that we had a market segment.
Yeah.
We have to remember that most of these tech companies funded their businesses from offshore capital. And we were in a cheap liquidity environment.
Capital. You see, when you get capital, it makes you do crazy things.
For what?
And it makes
You walked into that one. You walked into that one.
You walked into that one. But not the regulator determine the capital.
What I agree with you, Sam, what I agree with
You walked into that
100% is I think the methodology for the capital increases or the sort of the limits, I think it's probably very steep. And I hope that regulators look into that and rework it. But what I don't want us to leave here is to think that what exists today should continue.
But nobody made that argument.
But exactly.
There's nobody that has made that argument.
No.
Nobody that has made that argument.
It sounded like
But
that.
you could come across as that.
I question the quantum of the capital increase.
Yeah.
I
And the
question
methodology behind
the
that.
cliffs,
Yeah.
right? And I also want our regulations to be rational.
Yeah.
Because at the end of the day, we are advertising this market to foreign investors. You don't want a situation whereby somebody in London will look at our regulatory regime and say, these people, I'm not sure they know what they are doing. You understand? So, we need to, we are Nigerians. We should be best in class.
No doubt.
We have the intellectual capacity to come up with a regulatory regime that matches Europe, that matches. So the point is, when it looks like your regulatory decision doesn't factor in the underlying operating dynamics of the industry that you are supposed to regulate, we are not advertising this market in the way that we should be. We are all in this thing together, regulator, capital market operator. We want this market to boom. We will all benefit from it.
Yes, but I need to say something, and I hope we can all take this away from this conversation, that the bits and pieces of what will make the capital market juicy, that will make interest come, that people will invest, there will be innovation to create all kinds of products that will create retail access. All of those things will, one, not come from the regulator. It will come from participants. And at this particular point, it doesn't feel like the participants understand that there needs to be some collaborative build to allow the market move from the level it is to the next one. That is why, for me, I particularly support it, not because I generally feel it's going to make you do more, but I just believe that there needs to be less people in the room so that the voices are lower and so that you guys can agree on the next bill.
We're a capitalist environment, right? So this whole less people in the room.
It's competition now.
No.
And this was what Miffy
See,
did in
we are
UK,
not
right?
doing socialism and we are not
big
doing
banks,
charity. If it is business, it is capitalism. So let's not do that.
You're in a defensive mode.
No, I'm not defensive. I'm just saying, as long as it's business, let's not make it look like it is anything but business. If it is business, we understand that the best way for a business and an entrepreneur is monopoly. Now, we understand that that is also not the ideal for the society. So we need to come down. We need to find a middle ground between socialism and monopoly, right? So it is that place we must find. But in that place we must find.
But capitalism doesn't mean the absence of competition.
Or competition.
Yeah.
No. That's what I'm saying. That is the middle ground. So I'm just saying
but
now
the
in that middle
is not an
ground.
introduction
No.
of socialism.
In that middle ground, also because we're open to competition. Right? Because we're open to competition doesn't mean we throw out the fact that we are in this business to make money. And every time Sam,
big boys should be
now.
Okay, so are you saying that people should come together to build a tech? Is that the point?
Yeah, not just the tech. It's not tech. Tech is a garbage in, garbage out issue. It's about the policy conversations that builds the industry. Because Nibs was
getting the industry.
Yeah, that's what you're saying.
Nibs was a result of conversations. Nibs could have turned out to be a abacus. It was abacus, right? It could have been anything.
Sorry.
But at the end of the day, it was the policy conversations that built Nibs. I'm saying the room for capital market operators need to be small enough for you guys to speak about what builds the next level.
There was no thought leadership in that set of bankers.
Yes.
Nibs will not have existed. It's not.
I'm not saying it is the money.
Thought leadership is not
I'm
capital.
saying you guys are 1,000 plus or so. How many are you?
And then the top five can come together and say, let us move.
No, they will not do that. Now five, they will
without capital today. Yeah. Without capital today, and so that
I think we are having this argument the wrong way.
No.
I'm not saying that.
That's why I said that, because that's why I said I agree with you that it probably how it's been done.
Yeah.
Yeah, but at the same time, it's as if Otumba is saying we don't need capital at all. That's why I'm confused.
No. So we need to manage.
So are you saying, okay, let me ask, are you saying we don't need capital at all?
No, I've not said. I've never said
Okay,
that.
okay,
I'm just saying is that the issues that you are bringing up,
Yeah.
the availability of excessive capital does not solve it.
No, so
Right? If you have a dumb CEO, you have a dumb CEO. You have a smart CEO, you have a smart CEO. Right?
sure.
So let's
For sure.
So if you have some people that go to that set had a group of entrepreneurs who came
Yeah.
together and said, we want to drive thought leadership
Yeah.
and want to solve a problem.
Yeah.
If you have a bunch of CEOs that don't know what they're doing,
And give them
nothing,
capital.
nothing.
So
you
you're-
get
so
capital.
No,
nothing.
capital wasn't the reason
They'll
why
go
they were
ahead
there in
and
that
deploy
room.
all sorts, and nothing
right?
will still work.
There was a consolidation
but
that
do you
brought them into that room.
wait,
Can you remember?
Do you agree that we need to increase capital?
I agree. Yes.
Okay.
So, case closed. All right, everybody.
I mean,
That is-
it was a consolidation that brought that room.
The
Abi.
how is what we are.
We
The
will
how.
continue the conversation after this. If you,
Wow, there is a lot I thought we were going to talk about,
There's so many
especially on
things
the
we're going to
global
talk
side.
about. I don't know. Do we
Come-
go
come-
on? We
come
can
on.
go on if you
Come on,
guys
Nick.
are still here.
What
I'm still-
happened on the
I mean,
global
we
side?
split
Jesus, January
There's
was
so many
probably
things.
the
We had
Crazy
we had-
volatility.
So we can okay.
We can
Watch
go
out for
on.
part 2.
Yeah.
And now let's open part 2.
can do another 30
minutes
Yeah.
All right, guys, you're
It's not
welcome
gonna
to
be an
Drink Some
episode
Mics.
anyway.
You're welcome to Drink Some Mics. Wait. You're welcome to Drink Some Mics part 2.
All right, guys, this has been Drinks and Mics brought to you by Drinks. It's
How many hours?
This was
session.
intense.
You stay tuned
3
for the
hours.
second part of this show. You are freaking awesome.
You're a legend.
I was
The
in and
first
out.
part was fire. If you were here,
heated.
this is where it was. Well, in case you missed that part, you want to go back to it. It was a clash of titans. But of course, that's why we're here. We don't always agree all the time. And when was the last time you saw Tunji and I on the same side? I mean, so you can imagine. It was a hot Drinks and Mics. Thank you for being a part of the show. Thank you guys for being around. Until we do this again next time, do have a profitable week ahead. Goodbye.
All right.